Turn it.
We're on,
I thought I already did.
okay, it's 11:30. It's November 30th. We call the regular board meeting of the Montana Board of Investments to order. We are, of course, video recording the meeting, and so everyone be aware of that. And if we could start with the roll call.
You bet. All right, Carl England,
Here.
Terry Cohe,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Jack Prothero is absent, and Senator Ryan Lynch.
He will be joining us momentarily.
Okay, and Representative Ken Walsh.
Here.
All right, we do have a quorum.
Thank you. Are there any public comments on issues within the board's jurisdiction? Nothing in the room, and doesn't look like anybody who is online.
Nope, nothing on Zoom.
All right, thank you. We have meeting minutes from October 1920. Any additions or corrections to those? Seeing none, is there a motion to approve?
Second.
Maggie's moved, Diana's second. Anything from anyone? If not, all in favor, say aye. Aye. Any opposed? Motion passes unanimously. We have some administrative business from the audit committee and the loan committee. Maggie, why don't you do the audit committee first?
Okay, we were busy today, but we'll have 4 items to actually make decisions on, but I'll just give a real brief update that the financial audit status is that they completed their field work back in October. They're wrapping up the rest of their field work this month, and we'll have a tentative opinion supposedly by December 7th, I think is.
Opinion date is September 7th.
Executive director told us. The LAD is also working on commerce and cares related audits. More to come on that, so we'll hear about that in future meetings. The financial statements, we discussed them and we'll have a motion here in a second on those. Let's see. Discuss the annual report. Staff did a very nice job working with the chair, Mr. Chair Carl England. We reviewed the statutory compliance checklist, updated, and it will be submitted to the governor and legislator once it's finished. It has to be posted on our website by the end of December. We also discussed the annual audit charter compliance to make sure that we are in compliance with that charter. So let's see what else we've got. And we also reviewed the audit committee checklist that we review every meeting, and executive director reminded us that we will approve the finalized one sometime in February, correct? Okay. So first thing I'll do, I'll make a motion to approve our financial statements as submitted.
Is there a second?
Second.
Second.
Okay, and a third. Any discussion? Everybody attended the meeting, so
Yes.
we had plenty of discussion at the meeting. If not, anything from anyone? All in favor, say aye. Aye. Any opposed? Motion passes unanimously.
So I would also move that we approve the annual report with a few minor grammatical changes as submitted.
Is there a second?
Second.
Okay, Bruce is second. Any further discussion?
This is on the annual report?
Yeah.
Yes.
Okay. Mr. Chair, I'm going to abstain from this vote as well, as like I did in the committee meeting.
Okay, all right. And are we getting,
He's got it.
okay, if you have anything tomorrow, just.
Yeah, I probably won't. absent.
You have tonight to read it.
What else do you have, Mark?
Thank you. Thanks.
I tell you what, Mark, we'll give you till 10. If not, all in favor of the motion, please say aye.
Aye.
Any opposed? None. The motion passed unanimously with Member Barry abstaining.
We need to make a motion or a decision on the annual statutory compliance checklist, so I will move that we approve as we did in the committee.
Is there a second?
Second.
All right. Any further discussion? If not, all in favor, say aye. Any opposed? Motion passes unanimously.
And once again, on the annual audit charter compliance, that was really just saying that we're in compliance with that, and the committee indicated that we were, so I would make the motion that we approve it as a board.
Is there a second?
Second.
2 seconds?
2 seconds. Just 2 seconds.
All right.
All it takes.
Any discussion? If not, all in favor, say aye. Aye. Any opposed? Motion passes unanimously.
That's my update.
Thank you. It's a busy committee and you guys, for the record, we'll say something we've talked about a couple of times. How many audits?
7.
7 this year. So, and so far so good. Loan committee, in Jack's absence, Bruce chaired the loan committee. So Bruce.
Thanks, Mr. Chairman, and Jack is missed, so we hope he gets well soon. We've got 3 items for the board's consideration today. First one is loan committee considered bond resolution number 249 relating to $120 million annual adjustment rate municipal Finance Consolidation Act extendable bond intercap loan program taxable series 2022. And the reason I read the whole title out is that is actually the transition document for us from the way that the intercap program was previously conducted to the new structure. And thanks to Louise and everybody who worked very hard on this, we've now got a program that part of the reason that I am so supportive of this, as I said before, is that when Louise first brought this idea to the board, Jack, who I look to on issues like this, said, "Giddy up, let's go." So I really wish Jack was here to do this today, but in his absence, I'm happy to do it. Good work, everybody. And this is something that does take approval of the full board. So I will move adoption of bond resolution number 249.
Okay. Is there a second?
I'll second that.
All right. Is there any further discussion? I mean, I think in a nutshell, what this does is it will save our borrowers money. It will provide additional revenue into STIP. It will save money in terms of the costs of the program. It's hard to imagine
And expand eligible projects.
and expand eligible projects. It's hard to imagine more of a win-win-win situation.
For Montana.
Yeah, for Montana. And I think all of us at one point have said something like, why didn't we do this earlier? I hope that that's, and the reason, there are a lot of reasons why we didn't do it earlier. That's not a criticism. It's just that this is such an elegant,
We were bored.
such an elegant solution. It really is a remarkable piece of work. So I think with that, unless anybody else has any comments. All in favor, please say aye.
Aye.
Any opposed? None. And we got a couple of loans, correct?
Yeah, we've got a couple of loans that were over the approval authority of the loan committee. So we're bringing them to the full board. The first is the Big Sky School District number 72, $2 million to finance costs associated with building an offsite bus transportation facility. And I would like to move the adoption or concurrence of the board with that loan that passed unanimously in the loan committee.
Good. Yeah. Oh, go ahead.
I would so move.
Okay. Subject to the conditions contained in the staff
Subject to the
packet,
conditions contained therein.
right?
That's the motion.
Correct. Okay. Any discussion? If not, all in favor, say aye.
Aye.
Any opposed? Motion passes unanimously.
Yeah.
You seconded.
You seconded.
Yeah. Bruce moved it, you seconded.
It's kind of like an auction, you know? once you-
Did I raise your hand?
You are-
What did I buy? And I forgot my checkbook.
You're about to buy some expensive land.
And the second one is actually an example of the expanded ability to make loans under the new InterCap program with the loan to the Greenfields Irrigation District out of Fairfield to borrow $2,626,126 to finance costs associated with replacing the Arnold Cooley drop and adding a hydroelectric plant to the site. So I will so move for approval of that loan with the conditions that it contains.
Good. There's a second. You're not twitching this time?
I'll second.
All right, Mark seconds. All right. And I think it's important to note that Bruce put aside the rivalry between Fairfield and Fort Benton. He gave the loan.
Thank
Okay.
you, Mr. Chairman.
Anything else from anybody? If not, all in favor, say aye. Aye. Any opposed? Motion passes unanimously. Comments from our pension board member. We still have no TRS person. So
We're done
Maggie?
with loan.
We haven't met since our last board meeting. We meet next on the 7th and 8th. So
Okay.
the 7th is a committee meeting and the 8th.
All right. Well, since our
But
last,
can
Oh.
I say that our executive director will be here to present on the valuation? So
all right, we'll look forward to that. Comments from our board legislative liaisons. We have a new Senate.
We have a new Senate liaison, Senator Ryan Lynch. He just texted, he's actually reading at a children's hospital right now, so he may be a little delayed getting on. But I always thought I was in his Senate district. And I actually looked at the map and I'm closer to being in your House district. I'm off by like 3 houses of being in your House district. He's all the way up on the hill in Butte, so I have no chance of ever being in his district, but not that all of the legislators representing Silver Bow County has any coincidence or anything, but that just happens to be a thing right now.
Well, if he does get a chance to join us, I will stop and allow him to introduce.
We all thought you had 3 or 4 representatives and 5 or 6 senators apiece.
Right, that's how it works in Butte. So.
You vote in every precinct, you get a set of dishes from the mine.
Representative Walsh, do you want to top that? Yeah, you want to bring some sanity to this operation?
No, after the redistricting, maybe the executive director will be in my district. Who knows? But no, I have nothing to report, except that I've been learning quite a bit. I appreciate all the people answering questions as we go through this. So
Well, keep asking them because that's important.
Learn.
All right. Do you want to take 15 minutes and do the executive director report? You want, should we break?
I can do, why don't I do everything but C?
All right, let's do that.
So we didn't have any requests from the prior meeting. You have the monthly snapshot in the binder. Resolution 217, you have a copy of all of our authorized users. We are going to include Thomas in both private investments with Michael and in real estate, real assets until we get everybody covered. But John and I and Peggy will be on all of them as normal.
Because we're moving to the new approval system. with
Right.
CFM.
So one of our findings in the ICCP was we need investments and operations and accounting to approve transactions. So our investment staff will now be approving things within State Street to make sure that the capital calls are being funded appropriately. So you have all of those. You have our LPAC reporting annually. We are to report to you the costs and expenses of attending LPACs, limited partner advisory councils. Cheap year, travel didn't open up till late, so this number I would expect will be going up, hopefully, again, knock on wood. Only 9 of the staff now have blamed me for the Omicron variant because I said at some point we're going to be getting back to normal, and I said January 1 was it, and the next week found out there was a new variant. And then you also have the securities litigation annual review included. One thing to note, we are involved in the PG&E bankruptcy. So we will be hiring external counsel based on recommendations from our approved counsel to proceed with that. We believe that will lead to enhanced recoveries. But other than that, nothing out of the ordinary with our securities litigation practices for the year. And other than that,
Quick question. I just have a question on, this is on Aaron's report on page 2. How do we pay the people we hire to do this? Do they take a portion of it?
contingency.
Okay, great. So we don't have a cost unless we get something back. Thank you.
And is this net or gross? Net of fees or
These are net,
fees or net of fees?
these are net fees.
And so tell me about the PG&E bankruptcy. What do we have to do?
It's large enough that we're being advised that we need to secure separate counsel in order to represent us, because it is a massive, I mean, basically the forest fires of 2 years ago in California were caused by them. So we're just going to secure additional outside counsel to represent us again on a contingency basis.
Did we have both stock and bond or just stock?
Probably both. I don't know, Matt, are they on the approved list?
I mean, they wouldn't, I don't believe we had them from the internal portfolio. We may have had them within the external managers.
Gotcha.
Yeah, virtually certainly didn't have them internally, so
So you don't know what our exposure is.
I can go look it up, but I don't off the top of my head.
Round numbers?
We'll get you a number.
Okay.
Look,
Hey, Ramasco, will you get us a number on PG&E for Aaron?
Aaron,
Aaron on?
can do.
Thanks.
So Dan, we would have to get an outside counsel other than the 2 that we use for this type of recovery.
We've got multiple for this type of recovery, so we've got.
Maybe only listed 2.
So we've got FRT is another one. I don't know if we
Did
listed
we selected monitoring? Oh, just those are the monitoring.
monitoring
firms.
firms, yeah,
So they don't represent us then at these.
not in that instance, no.
And this person would also be, or this, firm or whatever, would also be on contingency.
Yes.
It's a different world, bankruptcy court. It's a completely different.
Yeah, it's like SEC lobbying. It's a different place with salaries that I dream of.
Yeah, which doesn't make any sense.
Sometime.
Yes.
That's a
Yeah, we
question.
do.
So on the LPAC report, I know it says here that it's according to code of ethics. But just the LPAC travel that is part of this report, or what's what does that say?
So this is just the LPAC travel. So our due diligence travel is separate and apart from. So all of our so within the LPACs, we will participate in big group lunches. That's a meeting. We will participate in big evening meetings. But, you know, to the extent that there's anything over the gift threshold, we will pay out of pocket. If there's a sidebar conversation being had between our staff and the general partners, we will cover that out of our per diem. That's why we reference the code of ethics and the travel piece. So we won't, big example, we will not accept reimbursement for a due diligence trip. That's out of our budget.
Right, this is travel that's paid for by someone else.
Oh,
Well, ultimately, we pay for it, right?
Right.
So we signed up to be a limited partner in these structures and
be on the LPAC.
be on the LPAC, requested to be on the LPAC so that we have insight into what it is that they're doing. And the expenses that they're paying for our travel are coming out of the fees that they're charging us to manage these investments. So, you know, it would be kind of a
that's the way consultants are.
We'd be doing it twice if we were to pay, you know, out of pocket ourselves. That wouldn't make any sense.
Additional questions?
I just, so on the securities litigation, we got a couple of law firms that are mentioned here that are monitoring firms. Do you give them a retainer? It's only when there's an actual litigation that they're involved in.
When there's a recovery, the only piece of the contract is when there's a recovery, they get that contingency fee. But there's basically a niche market out there now of people who just monitor these and go get them on our behalf and then take a percentage.
And they're just, I went to a conference with one of these groups, so, and they explained it to me that they monitor it and then they'll come to us and say, Executive Director Villa or John, do you want to be lead on this? And they'll say no. Most of the time.
All of the
All the
time.
Okay.
Unless it's one company, there's one company, I'm gonna come to you and ask to be a lead on.
So anyhow, that's kind of how they work, and then we fall into the bucket some places. And we can actually say we don't want to be part.
We could.
We could, but that-
Anything else? I had something, but I forgot.
You know what the one company is? I do.
Yeah.
I'll tell you at lunch.
I think we need to make sure that Moscow didn't spend the $180. The trust fund investment pool all in one place. So
I'll see to it.
will you see to that?
Hell, that was a 2-year high.
That was a 2-year high.
All right.
All right, and then we'll come back to see after lunch and we will break for lunch.
All right, sounds good.
All right. Recording is in progress. We got it. You want to click on that?
What?
You want to click on that?
Sure.
We're behind tab 2. We covered before lunch, we covered all the sort of reporting things. And so we have a decision on adopting a new board policy manual. Is that correct?
That is correct.
Did we get Jeff?
Jeff is not back on, but it's not because of us.
I should be,
Oh, there we go. All right. Good, thank you.
I could hear you.
We're sorry.
So, we have a board decision on the board policy manual. Dan?
So the policy manual before you is a codification of all of your existing board actions. So this would include the in-state loan program, policies that were separate and distinct from your governance manual. This would include incorporation of all of your charters for the committees, your staffing policies and procedures, our continuity. All of that was scattered across multiple documents housed somewhere within the organization. This codifies them into one place. What I would recommend to the board is that you adopt this with any substantive changes you may have to the policies therein today. And we spend basically calendar year 2022 going through and making them more, I'll call readable. So those grammatical errors that have been with us for decades, those clarifications or non-substantive changes, we spend time each meeting, go through the 100 or the 10 series and the 20 series, but do that in an incremental place rather than try to get it all done now. I know that Chair of the Audit Committee had recommended substantive change to the audit charter. So if you want to read me that, I can make that edit.
What I was proposing is that it read interim financial reports. And this is part of that, what we're going to review and stuff. So it's not a full sentence, just so everybody knows. So it's interim financial reports and consider whether they are complete and consistent with the information known to committee members, period. Get rid of the excessive language.
We've got that substantive change incorporated, and then you've also got other commas, apostrophes, grammars, things. So we'll incorporate that. Any questions on this?
This intercap loan replaces
What's currently in there based on the actions of the adoption of resolution 249 this morning?
Questions? Comments?
Well,
Discussion?
here's my discussion. I want to, how are we going to, how will that review be conducted? Will be involved? Do we have a technical writer?
I'm glad you asked. I think we need a subcommittee of the board to go through it. Because ultimately, these are your policies. These are not staff's policies. These are what you adopt to direct us. We then will develop over the next calendar year a procedures manual so that if anyone gets hit by a bus, except for Aaron, if Aaron hits a bus, we will be able to pick up the procedure manual and be able to do our business and continue it regularly. We have backup, we have succession planning, but the next step of that is formalizing our procedures in a procedure desk manual so that we're ready to go. That's a staff activity. So I think, and I would appreciate some subcommittee of the board coming together to work on these, as it is your document, on those sort of readability issues. Then we can send it off to a technical writer to do the, here's where a comma, here's where a semicolon, those sorts of things. But I don't want to put staff in the position of making a change that is viewed as substantive by the board.
I nominate Maggie.
Be on the committee.
Yeah.
I mean, I would be happy to,
Appointed.
I would be happy to help, but I think what Dan is saying, and I agree with you, conceptually, I think this is a great idea. I think we need to read our own policies and make sure that there are things that make sense, like this one we just asked about changing. It didn't even make any sense because it's not something we currently do, and I don't believe it's something we would ever do that way. But I'd be happy to help. If you do it one section at a time, it takes small bites.
Mhm.
It should be simple. Mark's retired.
Getting hit by a bus, being thrown under a bus.
Right under the bus.
I know, with trampolines. I know.
We all have our special.
Are you looking for a motion then to approve conceptually this?
Well, I mean, I think that's the decision that's in front of us, to approve this for now, with the understanding that what it is a codification of the existing policies with a significant amount of work to organize them so that they're not completely disorganized but then also, well, so that would be the motion, and then I think we need to make a decision after that about what happens next, because I agree with, I mean, I went through and just started doing when you used letters and when you used numbers and when there were bullet points. I mean, it's just, they could use some English.
See,
So that would be the motion, to approve this as our revised, as our policy.
Policy.
So, Mr. Chairman, to get things moving along, I'll make a motion to approve the board policy manual as presented.
There's a second.
Second that.
All right. Is there any further discussion on that motion? If not, all in favor, say aye. Aye. Any opposed? Motion passes unanimously. So now the next question is, there seems to be a general agreement that there needs to be a cleanup of the language and more grammatical style kinds of things.
Inconsistencies too, or things that aren't. I think we're gonna find some.
well, there are certainly instances where the board has given staff direction that if staff were to do something, here's how it's to be handled. Staff has then exercised the ability to say, well, we're just not going to do that. That instance that you pointed out, interim financial statements, not worth our time, not really a value add. If we were to do that, however, those would be the policies we're bound by. If the board chooses to eliminate some of that language, certainly not anything the staff would be opposed to, because again, these are your direction to us.
So my question on the sort of the next step is, if you I see it, well, I guess my question is that, are we gonna do another deep dive into tab 40, which is all the investment policies?
Yeah, that was gonna be my.
And I just don't see that as being.
So personal opinion, I don't think tab 20, tab 40, tab 90 need the work. Really, the bulk of the work is tab 10. And potentially, but I think it's actually in pretty good shape, tab 30 as well. Tab 40, you'll review every year anyway, in April as part of your regular work plan.
Well, so why don't we do this? Why don't we, let's see, I think we don't need a motion to do this. We have consensus that work needs to be done. And why don't we figure out when there's a time that people can get together to do it? We'll set it up. And the people who can come, we can just go through them. Does that work?
So, yeah, just on a volunteer
Yeah.
basis.
Yeah, and then we can do them in Word, because then we can track the changes and then bring them to the board and say, this is what, you know, you can see what we did.
Does every? Well, I don't want to think out loud here. We will, after the first of the year, I'll work with you to
After
set
the
up some
first of the year.
time. Okay, let's tackle TAP
Right.
10.
Right.
Here, and we'll just set up some time either over Zoom or Teams, or people can come in, whatever's your leisure.
Yeah.
And we'll go through and make sure things are how you want them.
That makes sense?
That works for me. It's, in order to get it done, though, we need to get this done at this point in time. And that sort of thing.
Well, so here's what I was thinking along the same lines Dan was, that we, you know, after the first of the year, we set up a day, or I don't know if it takes longer than a day to do tab 10. And then bring that to the board and see how that worked in terms of the results that we get as with that. And rather than appoint a committee, because I can see somebody wanting to, you know, having a day here or a day there to help, but not being able to do it all the time, we can just do it as a group. It's not big, I don't think it's big substantive changes. I think it's more a group of people sitting down and going, making sure we've gone through it word by word. And I'd be happy.
Some sections just don't make, little sections don't make sense. Paragraphs don't, you gotta go, what the heck?
Yeah.
Yeah.
So does that work? And then if in February we haven't, that's our next board meeting, right? February?
Mhm.
If we haven't, if we've got no progress to report or nothing's been done, then somebody can raise the issue and say, let's do this a little bit more formally. In which case we'll give it to the HR committee and. With the legislative liaison or two. So does that work?
Yes.
All right, so we don't need to do anything with that?
Nope.
Other than put that on the list of
So you-
things that,
We'll have that on the work plan for next year, and then board members, you can take these home. So you have a copy at home, and we will keep a copy of these here for you as well. So you're working remote, you've got it there, but there'll also be a stack of them here, so you don't have to carry
we have
two
them, right?
binders with you every time you come in here.
all right, any,
Sorry, I probably not paying enough attention to something that I was involved with, but what are we actually putting in the new policy manual out of here for Intercap?
Just the new policy that was on your desk. So if that 70.100 policy you already ripped out of there and put it in there.
I already
you're-
put it in.
Yep, then you're good.
Okay. All right. You can be on the subcommittee. I forgot something.
yeah, he's proven his
I
ability to be on the
I
subcommittee.
forgot that I did it.
Yeah. Terry forgot she seconded the motion.
Yeah. Terry, welcome to the club.
Yeah. So is that it behind tab 2?
That's it. Thank you.
You know, I want to take 1 minute here. Do we hear from Senator Lynch? Doesn't
Does
look like
not-
it.
Well, hold on, there's another page. No, not
Okay.
yet. I will let you know when he's.
Okay.
joins us.
And then, as I always like to do when he comes, it's in the room with us today is our former Chief Investment Officer, Cliff Sheets. to build the foundation upon which we've been working for a long time. And served us very well. So welcome. Nice to see you.
Thank you.
Yeah. I put him in charge of snow this year, so he's fallen down on that. All right,
We
tab
offered him
3.
Some candy, but he ate it all.
And everybody else.
I'm still willing to trade some dark chocolate. Tab 3, new commitments. Ethan. You with us?
Sure am. You guys hear me okay?
You're a little muffled.
I'm a little muffled. Well, I'll lean forward. Can you hear me
There
better?
you go.
Okay, great, thanks.
The top of your head.
Now we see the top of your head.
Hold on, Zach. How's that?
It's actually terrible. Ethan.
The wonderful world of Zoom. I'd be happy to be in there with you, but I was told I have to do this on video. So, I guess this is what we're gonna have to live with.
Just come on down.
Ethan.
Yay.
So he's gonna come down and lean in and talk.
You gotta do yours from the office, though.
I think Thomas's computer works.
Yeah, he's got a headset.
He got his tree decorated too. Nice, Thomas.
Everyone. Much better. All right, so enough of the comedy relief here. All right, thanks for having me today. It's good to see you all. Welcome to the board. I have before us OCP Asia Opportunities Fund. OCP is not a new manager to us. We have 3 prior commitments with them in our private investments portfolio in the form of private credit. This fund represented a unique opportunity to complete, in my opinion, the commercial real estate debt portfolio from a senior loan perspective. Many of the commercial real estate lenders of the world these days that are originating loans to finance the senior part of the real estate capital stack are facing yields of 2.5%, 3%, maybe 4% in extreme cases, very small returns. And as a result of that, have layered on 2, 3, 4, in some cases, even 5 times leverage to juice those returns. And so as a result of that additional financial leverage, I have strayed away from looking at those types of funds because I didn't like the risk profile. You may say, well, why does Southeast Asia make you more comfortable? Well, for one thing, we know the manager very well. They are highly credit oriented and very risk averse and have done very well for us on the private credit side, financing these other companies. They are essentially doing the exact same thing, except they are focused on companies that derive their primary source of revenue and earnings from owning and operating and developing real estate. They are originating senior loans to help companies finance acquisitions, refinance developments, et cetera. They collateralize these loans 3, 4, 5 times, and oftentimes much greater than that with both onshore and offshore assets. Onshore being, if they're originating a loan based in Singapore, there may be assets that they use as part of the collateral package that are right there in Singapore. There may be a broader asset pool, and they may, for example, one of their loans, they own and operate real estate right here in the good old US of A. Although the company's in Singapore, for example, or Australia. But a very known quantity, have done well, have a lot of confidence in them, have extreme confidence in their credit underwriting, their aversion to risk, their structuring, And this was a great addition to the real estate portfolio. They've been operating in Southeast Asia for a number of years. All the principals have been living there most of their lives. Great terms, great portfolio completion. I'm happy to answer any questions.
Complete the private debt.
Yeah, so to talk about that, currently we have Angelo Gordon, Commercial Real Estate Debt Opportunities Fund, which is a very opportunistic strategy that plays sort of throughout the debt capital stack. They can buy loans, they can originate loans throughout the capital stack, they can buy bonds. Very opportunistic wherever they see value, frankly. We have Walton Street Real Estate Debt Fund 2, which basically originates a whole loan, sells the senior part to a bank or an insurance company with a very low yield, which matches their needs. And then they hold the sort of mezz piece, if you will, somewhere in that 75 to call it 48% of the capital stack, much higher yielding, but that's sort of your mezz piece. You know, if you think about equity, mezzanine, senior, to keep it real simple, seniors at the top, the least risky, mezz is in the middle, the more risky, and then you've got your equity, which is, you know, at risk. We have our high yield CMBS position in our 1940 Act mutual fund with Fidelity that, you know, will buy high yield CMBS. And then we have OCP, which completes the senior piece, which none of the others that I've previously described will do. So.
And then also international versus all those other ones.
So complete in terms of.
From a
we've covered the
portfolio
financial
construction
stack.
perspective, I feel like I've covered the entire capital stack with differentiated strategies with groups that I think will serve us well through time. So likely will not be, you know, all things remaining stable and equal, will not be looking to add new positions. We'll just continue to serially reinvest with our existing partners. It's all about high conviction, bigger, fewer, stronger relationships, information asymmetries in the public markets or private markets, harnessing those and seeking out performance versus building an index.
Thank you.
Sure. At least that's my personal investment philosophy. It's not right or wrong. Yes, Bruce.
So, as far as being able to get the assets, you talked about that their loans are collateralized 3 to 5 times. And I thought you alluded to with assets we can get to.
Sure. They can foreclose on the assets. They can take ownership of the offshore entities. They have all sorts of lock boxes in place whereby they have control of bank accounts, so they can effectuate and control monthly cash sweeps for debt service, et cetera. Very locked up, locked down, belt and suspenders, and then some. They can force sales. They can sell assets to pay off loans. You name it, they can pretty much do it. And overall, they have a loss ratio of, I think, just less than 1% across their entire portfolio, across their entire firm life, across, I think, $1.8 billion of realized assets, another $1.2 billion of unrealized assets. So very low loss ratio. You know, just have been very successful and very risk averse. And have structured around the risk appropriately and controlled for it.
So what are they selling the borrower?
I'm sorry?
I mean, it sounds like the deals that they structure are all good for the lender.
They are
What is
indeed.
it that so how is it they finding borrowers?
So another really unique aspect of this firm is over 50%, probably on order of 75% of their clients or borrowers, if you will, are all repeat borrowers. OCP has really carved out a little niche for itself across the Southeast Asia market, Asia Pacific, because they do stuff in Australia as well. They're very discreet capital. They're very nimble. They service a lot of the big, oligarch families over there. The bank market is very, it just tends not to look at the sorts of deals because of size, because of complexity, because of timing constraints that OCP will take on and entertain. And as a result of that, as a result of their, ability to deal with complexity, ability to deal with abbreviated timeframes, ability to deal discreetly and quietly with these banks who want to borrowers who don't want to necessarily deal with banks or be in the headlines, they can excise their pound of flesh, if you will, and charge a premium rate. Or as Cliff used to say, usurious interest rates. You did indeed. I was listening, Cliff. I miss you.
Mark?
So prior commitments, you got this one that was issued in 2020 that has a negative IRR. And that was for $50 million, but now you want to jump in with another 100 million. So what's going on with that prior commitment?
So maybe I'll take that one. So these are different strategies. So we've had a relationship with OCP before, but it's in the private investment side, and they do kind of a broader set of loans. So it's not always real estate focused, although to Ethan's point prior, it's the same strategy. So within, this is probably a little more recent as we've looked at particularly the debt type strategies. And I know, we're talking Southeast Asia, all those things, but on a relative basis in this world, the debt type strategies are, safer than, say a private equity strategy or something of that nature, but are certainly venture capital, something like that. So we have basically made a decision on the debt side. So we have the other debt managers that Ethan mentioned, Angela Gordon and such. We've sized them at 100 million. How did we come up with that, or how did I come up with that? I guess at the end of the day, the portfolio has grown enormously over time. But B, 100 million is not even, it's like 0.67% of the overall cap portfolio. So it's not, if we were talking about a public markets manager, set a cap of 0.5%, no more than 5% in a public market manager. Even with all of these things that we have, and you have to recognize that some of these initial strategies that we have on here, money's starting to flow back to us. Orchard Landmark 2 is basically done and returning capital. So, these things are always rolling over. The OCP Asia Fund 3 is going to start being in that place. So even though there's kind of a lot of money on that page, there's not actually as much money with this manager, because some of those are starting to just pay out and pay back and, to the next fund. But, long story short, in the debt fund in this instance, more comfortable just sizing up here.
Okay, so
Consistent with our other.
are these all private, previous ones, are these all?
They are, they're just a broader set of that, and they would be in Michael's bucket in the private investment strategy.
But the minus 28 is because of.
That's
still
because
paying,
that's because of the J curve. I mean, it's just early days. They haven't got a lot of money on the ground. Absolutely.
Anything else? Yes.
Yeah, so the 100 million, because, I've seen a few of these now over the last couple of years, and this might not be the first one, I don't recall, but it's one of the few that we've been up that high, 200 million.
It is.
Are
So
we,
Rod's,
and it's, like you say, we got more money now, so gotta go somewhere.
we got more money. We've decided to make, larger position sizes with our high conviction existing managers and kind of shrink, just because we had so many managers in the portfolio. So I'll give you my broad, like back of the envelope type numbers, if we're talking about venture capital, it's probably most of the time closer to 25 million. If we're talking like the private equity buyout strategies or private equity growth, it's going to be in that $50 million range. And the debt type structures like this, it can be up to maybe 100 million. That's, you know, I'm not saying it's that every single time or anything like that, but big picture, that's kind of the numbers that we're currently
You're gonna
shooting
be
at.
in the ballpark in each one of those categories.
And to be honest, we've started because assets have grown so much over the last year or so here, as we're looking at our pacing studies that RBK did for us recently, both within Ethan's world and Michael's world.
You gotta
We're
ramp it
starting to
up.
wonder if we're gonna, you know, we're starting to think, well, maybe it's gonna be 60 million next year in the private equity buyout type buckets. You know, so we're sort of having that conversation currently as far as, you know, what's the right number for some of these things to get us to, because we're shooting at, you know, I think next year, private equity is going to be, call it 450 million in terms of our pacing. Real estate's going to be, you know, call it 300, and real assets is another 200 or so. So
$1 billion.
Those numbers get big quick, and you know, and there's only so many of these relationships we can kind of maintain, I think, is part of what we will want to maintain, I guess, in some instances as well.
Other questions? Thanks, Ethan.
You bet.
We'll see
Thank
you later. I guess.
Sounds good. Look forward to it.
All right, and then we've got the Kinderhook Capital Fund. Michael, Thomas, who's doing that?
I'll take that if you don't mind.
No, we don't mind at all.
All right. Good. Well, Mr. Chairman, members of the board, thank you very much. Good afternoon. A little bit more straightforward, I believe, than Ethan's board brief, but I'll walk you through. I'll walk you through a little bit, you know, Kinderhook Fund 7, as you can see here, and to the comments related back to John Putnam and Ethan as well. A re-up opportunity in, you know, continuing the theme for this year, a longer dated, stronger, bigger relationship we've had with Kinderhook. As you can see here, we've been investing in Fund 4, 5, and 6 with 20 and 35 million respectively. We committed to Fund 7 to continue that very successful relationship with a $50 million commitment in line with the pacing that John touched on, and also just continuation of the relationship to make bigger, sizable checks commitment to these strategies. As I mentioned, MBOI has a long relationship with Kinderhook, the firm, primarily the 3 partners and founders. Those folks have been together, investing together for almost 20 years. They were actually roommates in business school. Pretty interesting relationship there. And they have built a very deep, experienced, strong, stable team around themselves to continue the strategy of Kinderhook, primarily focused on family-owned entrepreneurial businesses where they take ownership or corporate carve-outs and then grow these businesses and then sell them in the market, in the M&A market. Primarily focused on North America. Subsectors, as you can see here, is that automotive, light manufacturing, healthcare, environmental services, which they have done very successfully over the past 3, 4, 5 funds. It will be diversified throughout North America, primarily the US. One last comment here I wanted to make. We are an LPAC member, just to link it back to Dan Villa's comments earlier about LPAC related travel. So we do expect to be on the road here for Kinderhook, specifically since we have now a relationship with 4 of their funds. That leave it there for any comments or questions.
So why did we decide to be an LPAC member?
The LPAC membership goes back to a relationship building with the general partner, with the with the firm. So as an LPAC member, a limited partner advisory council or committee member, you do have a little bit more insight in some of the information that is presented. You have a bigger voice when it comes to the relationship. So we try to be very good partners with all of our managers, and where the opportunity arises or presents itself, we like to be on the Limited Partnership Advisory Committee, the LPAC, just to have our voice heard and have a stronger voice in that relationship.
Questions?
Anything else?
No?
If not,
Thanks, Thomas.
no problem. Thank you very much.
All right. All right. Tab 4. Asset allocation.
Mr. Chairman, members of the board, this is the same memo and info that you had in October that we discussed regarding the proposed asset allocation. Fairly modest changes, as you can see on the main page there, up a little bit in real estate and non-core fixed income and a little down in core fixed income and cash. Beyond that, I won't repeat myself, I guess, from last go around, but I'm happy to answer any additional questions that you may have come up with between October and now.
We should have a lot of discussion. This is a pretty significant change.
That's not what you said in board. This is a nothing burger. As you
Between questions that have arisen between now and October, when I know most of us have thought of nothing else. Any additional comments? I think we heard, Becky, we heard from you last time, didn't we?
You know, we looked at the changes. We did talk about it in Portland for the group that was gathered there. And if you look at the assumed returns or the return potential for cash and for core fixed income, those are on the very bottom of the barrel. And so looking at ways to find a better return and a better yield, real estate and non-core totally makes sense to us. So we're completely aligned.
Okay. Well,
But if private investments are doing so well, you didn't change those. You just don't want to take the risk.
So one of the comments I think I made last go round was, we're still kind of right around the range with private investments and real assets. We moved those up last year by some margin. I don't recall exactly how much. I think we're fine where we are currently. There is an ongoing intent to, kind of keep moving in that direction, but we're methodical and thoughtful about how we do that, all of the kind of the pacing study. And, mindful of the liquidity that exists in that space as well. So I think very likely that, maybe next year I come back and we do move the needle slightly there, continue to kind of push that up, but don't ask this go round because I just don't think it's needed. All that would serve to do is basically set the bar higher, and we would be further away from our midpoint, and it would create some noise in terms of our benchmarking discussions and such. And I know you all love to have benchmarking discussions and all of that. So leaving it alone for now, but certainly an area that we would continue to probably honestly as we go along.
I think the last time we talked about this, I asked you about that and asked you about sort of things that I vaguely remember from after 2008 when endowments were, heavily invested in private investments. And you told me I didn't need to worry about that because you were nowhere near I think you called it the level of endowments. What is that?
So
what is that level?
Becky probably has a better handle on it, but it's much higher than we are. I want to say, 50% or better probably in the illiquids. If not
Michael has
more.
it tattooed on the back of his hand.
And they're also, they tend to be, they have virtually nothing sometimes in say core fixed income, much less public equity, but Becky's getting numbers.
So I've got the endowment and foundation universe. There's about 123 in our universe that are 500 million and greater. And so just keep in mind the billion and greater are even more extreme in terms of their alternatives allocation. But the median alternatives, which would be a combination of hedge funds and private equity, is 35%. So, and fixed income, the median is 13. And equity is much lighter as well. It's like 34%. So those organizations have been pursuing even higher rates of return. They've got access, liquidity. They may have spending rates that are somewhere in the sub 4% range for higher ed institutions. So you compare the payout versus what a pension plan that's more mature may need to support. So there's a lot of different dynamics in terms of their asset allocation, but these type of numbers are what we see on an ongoing basis. There's a heavy private allocation.
And that's, you said 35, and then if they're bigger, they're
Even more, like 50, 40. Yeah, that,
and if it's a long explanation, just tell me it's a long explanation. We may not have time for it. Why is that? Why the bigger they are, with the more they would? Because they've got enough in liquid stuff.
couple things. One is that they've got access. A lot of times, if you think about a higher ed institution, like Yale or Harvard, they've got connections into the hedge fund community, the private equity community. Not saying it's kind of a, a clubby atmosphere, but sometimes it is. So they've got that access.
That's why we have Thomas.
Right. And they have, some of them have very high return goals. And so when they're looking at the most likely way to hit those return goals, they're going into the private markets. Now, what I thought you were going to ask is what they do during the GFC, when you had their liquid assets fall dramatically and
Right.
they became overweighted to privates.
Right.
Some of them had credit lines that they could access for their spending, their 5% or less spending every year, rather than disrupting an illiquid portfolio or selling the liquids that were depressed in price. So with that high allocation, sometimes comes some issues when the markets drop.
Right. Well, I remember the issues. I didn't really know what to do about it. I just remember that there was a bunch of stuff in the press about how they were over.
Yep.
When you'll remember a few years ago, RBK had done an analysis of kind of, well, how much liquidity do we need? I don't remember what the exact number was, but we were a long ways
Yes.
from it.
60% could be
Yeah.
illiquids before we have to worry.
Kind of have an
Yeah.
issue, yeah. And I got some similar feedback from BlackRock this year when they kind of do a annual analysis similar to that for us. And similarly, we were quite a ways away from.
Yeah, just, I mean, this is probably not adding too much, but, and I'm jumping in really late, but just that analysis, I mean, you've kind of, I've heard it, several pieces of it, but at the end of the day, I think Harvard was the benchmark, and they had leveraged their portfolio. First of all, they have a higher spending rate when you compare it to your distribution rate. And they don't have contributions coming in like you do. They have new contributions, but it adds to the corpus. And at the end of the day, when we looked at it, when we ran the simulations, it's like, yes, if you have a big sell-off in equity, you're going to have to rebalance, but you have a fixed income pool that has a decent amount of assets that are going to rise, which, like John said, Harvard didn't have, that offsets it. So it was almost a good thing, right? I mean, your assets go up, you rebalance, and it would just take so much. I mean, I think 60% was probably the number, but it felt like it took more than that, to be honest with you. But the dynamics were very different than Harvard in a lot of respects, and that's why it wasn't a risk for you at the level you were at, or even close to where you're at.
Can I just ask, so you said that the spending rates for these endowments are like 4 or 5%, something in that neighborhood. So what's our spending rate for a cap?
It's ballpark around 3% at the moment.
All right, anything else? If not, is there a motion to approve the proposed asset allocation?
I'll move the proposed asset.
Okay, is there a second? Bruce is seconded. Any further discussion? And Right, with the motion comes with changes in the investment policy. Is that right?
Yes.
Okay. All right. If not, no more discussion. All in favor, say aye. Aye. Any opposed? Motion passes unanimously. And I appreciate the fact that we do this over 2 months or 2 meetings. It really does. Tab 5, RVK, in person.
In person, well, half of this is in person, half this is online. So Mark is going to take us through.
Well, the best is in person.
Aw.
Sorry, Mark.
So Mark is going to take us through the capital markets and executive.
I'm off mute now. By the way, thanks, Carl, because it is my birthday today. I'm not joking.
Oh.
Is it really?
It is.
Happy birthday.
Well, happy birthday.
Thank you.
39.
Yeah,
Yeah, not quite.
yeah.
A little older than that. So, I'll basically just start with an overview of capital markets, which is always interesting these days. And then since Becky's live, she'll kind of walk through the performance report. As always, we always emphasize it. Take your liberty in reading the executive summary if you don't have time to go through our 5,000-page performance report. It's all obviously necessary, but if you are stretched for time, feel free to read through the executive summary. It gives you about 80% of what we end up going over. So if you flip to the executive summary, and Becky, I don't know if you can guide them. I'm not sure. I think it's in tab 5,
5,
but I'm
right.
not sure if that matches with what you have in front of you. But
No, it does.
Okay, good. So I'll be highlighting a couple things in the executive summary, but I'm not going to go through it exactly the same. We start off with a quote from Milton Friedman. The biggest issue that has been the subject of debate has been inflation. We have had 6 months now. It's probably going to be 7, although we'll see what happens with the new strain. But we have had 6 months at least of inflation of 5% or more, which is something that we haven't seen in quite some time. The thing that I come to appreciate more and more with every day is that it seems like the thing that investors neglect to their detriment is really digging down into history. And what I found, and I know I've talked about this a few times, is the more you read about history and immerse yourself in history, you realize that you start seeing patterns that wouldn't be obvious otherwise. One example is, if you remember back to the market sell-off in 2020, that seemed unprecedented for an economy just to completely take a shock like that overnight. But if you rewind to July 29th on 1914, the same exact thing happened. Nobody expected World War I coming. When it came, it was a complete shock to the United States. The whole market panicked. They actually didn't have the Fed in place then, but the market ended up getting flooded with liquidity, and it went through a scenario that looked exactly like March 2020. Now we're dealing with the same thing, but it does seem like people are getting a little confused. So the recent spike in inflation, it seems to be prompting fears of an event like the 1970s, the Great Inflation. I mean, it's called the 1970s, but 1968 to 1982. It was 14 years, which I'm sure everybody in this room remembers. I even remember my parents teaching me about inflation when I was 6 or 7 years old. It seems like I'm sorry, is there a question or? Okay.
So, Mark, I just said, ouch.
Yeah. Well, they taught me early, I guess. But so the immediate fear is, because that's such a salient experience, and in people's minds is that we're going back there. But when you pick apart the underlying economic conditions that we face right now, not that it can't turn into the 1970s, although it does seem like it's unlikely. When you pick apart the conditions, it doesn't look like that. It looks like what is typical of a post-war type event. If you look at COVID as a full mobilization war, which there are many attributes that are like that, if you compare it to World War I and World War II, they both were followed by periods of, transitory inflation. Now, by transitory, that doesn't mean a couple months. It was 2 to 3 years of higher inflation, both of which, by the way, were followed by a brief period of deflation. But if you look at the underlying conditions, they're very similar to what they are today, which is you had large fiscal deficits that were monetized by the Federal Reserve. You had large increases in savings, some of it involuntary because of rationing, but a lot of it voluntary because things don't look very good during a world war. Which, by the way, World War I had a pandemic in it too, so that was a particularly bad one. So people start saving, they start hoarding because they're scared. And then you also had holes in the labor force because of the call-ups in the military. So that ended up, it took a while to integrate people back in. There was wage pressure when things recovered, but most of all, there was a ton of pent-up demand, and nobody knew what it would look like when things started going back to normal. And you had the supply chain disruptions, the same exact thing that you're seeing right now after World War I and World War II. Now, in contrast to that, the 1970s looked a lot different. So that was, when you boil it down, that was really a Fed kind of losing control. And there are several reasons for that. Probably one of the biggest, at least initially, was they didn't understand the trade-off between unemployment and price stability. So they thought that the goal, the primary mandate, it wasn't a balanced mandate. It's a balanced mandate now because of the 1970s. The goal was to minimize unemployment. And what the Fed didn't realize is you can only minimize it to a certain point, and then you just drive inflation because there's a natural rate of unemployment. It's frictional, and if you try to drive it past that, you're just going to drive up inflation. So that was the big cause. And then secondly, just once it started taking root and expectations set in, which is the quote that we start the executive summary, and there's a chart that shows what inflation expectations look like on page 5. Once that sets in, it is really hard to break it. And it requires a lot of political will. And it took 4 presidents before somebody was willing to back Volcker with the political capital that he needed to raise interest rates to 20% and finally break the back of inflation. So that can happen. It would probably take some more time. The quote from Milton Friedman is it generally takes 2 to 5 years for higher inflation expectations to set in. If you look at page 5, it's actually a really interesting chart from, there's a manager there's very few conference calls I sit in on, but this is one of them, from Guggenheim Investments. And they looked at what inflation this is a kind of proxy for inflation expectations. If you look at 1978, when people were thinking about buying durable goods, they wanted to accelerate those purchases as much as possible because they were expecting the prices to go up. So that's that kind of maroon bar. If you look at it, now this is as of August 31st, so it's not completely recent, but it's the opposite now. Most people are delaying purchases because they feel that this inflation is going to be transitory. Prices are at worst going to flatline, maybe even come down. So you're seeing the opposite dynamic. So at least as of August 31st, it didn't look like those expectations, which usually take 2 to 5 years to set in, have set in yet. That coupled with the fact that it does seem like if you look back in history, the last problem is it doesn't usually repeat. And the last problem was the Fed overemphasizing unemployment at the expense of price stability. The reason that you have a large reason why you have the balanced mandate now is because of the problem that caused. So nobody knows, but it does seem unlikely that the Fed's going to abandon that, given what happened in the 1970s. You are starting to see some signaling in terms of some tapering. There's been some acceleration of the Fed's expectations in terms of when interest rates are going to need to rise in 2022. It was a big announcement that the nomination of Powell for a second term, he was deemed to be more hawkish relative to some of the replacements that were being tossed around. So this is a long story, but it does seem like if you're a betting person, it does seem like the odds are still likely in the transitory camp. There may have been some confusion as to what transitory means. That if World War I and World War II are the comparisons, that doesn't mean it's going to be a couple months. Call it 18 to 36 months, probably on the longer end. Because if you look at how they responded in World War I don't see that happening again. I don't see the Fed in 1920, they raised rates by 200 basis points in 6 months. I don't think that's going to happen. So maybe it's on the longer end, but it's not. In neither of those cases was it a couple month thing. It was, call it a year and a half to 3 years. Now, can that change? Yes. If it does change, it does seem like there's only one real variable here, which is the Fed. The Fed can turn this off if they want to, or they can let it run if they want to. But it does seem like the odds are more on the side of, they're not going to let it run. But when I pause there, this does tend to prompt questions, comments, and obviously there's room for disagreement here. But when I pause there, what questions do people have before we get into just a little more market performance?
Questions from anyone? Performance, Mark.
Well,
Go ahead.
so here we have a situation, and tell me if this has happened before in these high inflation periods, but we've got a situation now where we're getting a lot of money dumped into the economy.
Yep.
From the government.
Yep.
Now that's gonna drive inflation. That's gonna drive prices higher, and so it's gonna maintain that inflation rate for a longer period of time. It's not gonna be pressured for interest rates necessarily, unless you've got to force it up to shut it off. But it seems to me that the inflation is going to be more than just transitory.
I mean, I guess it depends on how you. So at the end of you're right. The question is how long. Using those historical parallels, call it 2 to 3 years. We're not there yet. But Ray Dalio is an exceptional writer. He actually just recently released a book today that I ordered on the changing world order. But he wrote a book on big debt cycles, and the only way I can explain it's like a game of Monopoly. I mean, it sounds silly, but that's sort of how things work. And late in the game of Monopoly, everybody owns properties, and there's not much money out there. So what happens if everyone tries to sell it at the same time? If everyone tries to sell it at the same time, there's only a certain amount of money out there, so they're going to have to drop the prices. So that's essentially what happens in a panic. Everyone's trying to sell at the same time. There's not enough cash out there, so things start contracting. And the way you react to an event like that is you print more money, and people fear that printing money is going to cause inflation, but it doesn't if it's just stopping the collapse. And if you look back at the Great Depression, that's precisely what they failed to do. And I mean, there's a lot of things that they failed to do, but that's one of the big ones. And it's because of the fear that everyone has this connotation of printing money is bad, which, if you're in Weimar Germany in the early 1920s, it was very bad, but that was some different situation. There was some different circumstances. But so what happened in March 2020 is you had that panic where everyone wants to sell things. There's not enough cash, and things start contracting. So what the government does is they start printing money, and that stops the contraction. And that's why you didn't see inflation spike for a while. Now, where it becomes problematic is if the economy starts picking up again, and they don't withdraw that, and that's where inflation can become problematic. And it seems like that's happening, but there's also the dynamic of supply chains are just completely disrupted right now because of COVID. As people start spending differently, as people dropped out of the workforce, that stuff will correct, but it's not going to correct overnight. But at the end of the day, that can't cause 14 years of inflation. What will cause 14 years of inflation is irresponsible, negligent, I guess you could call it, expansion of the money supply. And that takes, the Fed can turn that off if they choose. Now, if they choose not to, yes, it can turn into a great inflation type of event. I just wouldn't, me personally, I wouldn't bet on that. But we'll see. The thing to keep an eye on is the Fed, not the supply chain issues. The supply chain issues will resolve themselves. The Fed will, if this turns into the great inflation, it's because the Fed messed up. Does that's a long answer to your question. I don't know if that answers it.
So Mark, that makes sense, well, both Marks, but makes sense to me, except to me, the wild card here is the big infrastructure bill. And that's the part I can't fit into the explanation you're giving.
So, that's an interesting point. Aaron actually brought that up. Can fiscal policy alone cause inflation? And I guess the way to look at fiscal policy, this is my understanding of it, is it's sort of like a trigger of inflation. And this was actually one of the problems in the 1970s. Is there's a good quote by Chairman Martin, I forget his full name, but he had a good quote, which is, and this was some of the legacy of World War II too. The Fed saw it as its job to support fiscal policy. So you had these expansionary, the Great Society in the 1970s. You had expansionary fiscal policy, and the Fed saw it as its job to align with that. At the end of the day, the Fed can counteract fiscal policy. And if fiscal policy is expansionary and the Fed is independent, and they see inflation picking up because this $1 trillion infrastructure bill, they can raise interest rates. They can not only taper, but start selling assets. And I know it may not seem that way, but the Fed has absolute control over the money supply, provided that there's not political interference. That's what, if you read Milton Friedman, which is the economist that's quoted, he wrote a book that if you can get through it, my hat's off to you. I got through most of it. I couldn't get through all of it. But it goes through a monetary history of the United States from, the mid 1850s through, actually ended in 1967, right when the Great Inflation was picking up. And it's a pretty inflation is caused by excess money in the system. Excess money in excess of growth that the economy can support. And yes, you can have spasms of inflation that are due to supply chain shocks and wage pressure, but it just can't last unless the monetary policy allows it. And even with fiscal policy that's expansionary, like you said, with the infrastructure, Terry, monetary policy can offset that if it chooses to. I don't know if that makes sense.
If it chooses to.
But one other.
And it may not. My bet is it will, but it's true. That is the risk.
But one other thing you said is that if the economy is growing also, and so if the infrastructure really works and the economy grows, then the need for the Fed intervention would not be as much, correct?
Yes, I would. I guess
Correct, yeah.
that is, all fiscal policy is not necessarily the same either, because there's a big difference between saying we're just going to cut everybody a check so they can make it through COVID to saying we're gonna have an infrastructure package that's going to build roads and bridges, which is going to take years to get all of that money out into the economy to do it, but also there is an economic benefit attached to much of that infrastructure that you may choose.
But I didn't catch who said that, but it's true. That is the risk if the Fed chooses to. If the Fed chooses not to, they have the power to stop inflation and they have the power to cause it. That is for the long-term inflation, that is the variable. It's not, the supply chain stuff will work out. It may not work out on a time frame that everyone's comfortable with, but it will work out. But if the Fed allows, I mean, they have flooded the market with liquidity. And if they don't pull it back and things get out of control and inflation expectations set in, yeah, I mean, we have a problem. I don't see that happening, but that's not to say it can't.
Okay, anything else?
Well, that's pretty much it. Why don't I turn it over to, I know I've taken a bit of time on this. Why don't I turn it over to Becky to go through the performance to cheer you up a little more. I know I don't know if that's depressing or not, but I'll turn it over to Becky to kind of review performance.
Sounds good. Thank you, Mark. So let's go to the next section and go to page 6. So there's just a few pages I thought I'd highlight in your performance report. From an absolute number perspective, as you saw the executive summary, you saw that there was a lot of worry and a lot of fear in the third quarter. And the resulting numbers ended up being very small in terms of absolute returns. But the good news is they were positive, which is a good thing, especially when the market was worried about inflation and variance and supply chain issues and all the things that Mark was reviewing. So on page 6, I just wanted to point out the retirement plans balance, and that is about $14.7 billion as of the end of September, with PERS being about $7.3 billion and teachers of 5.1. And moving ahead to page 6, and let me know if your page numbers are different than mine.
Are you in the summary? You're in the.
I'm not in the web book, but the section 2, so not in the executive summary that Mark was just reviewing.
So you're in the second.
Yeah.
The quarterly investment.
Yeah, the 600 page performance report.
Right. Oh, so page 6 has.
Page 6 was right, just the totals for the retirement plan at
Right.
14.7. And I'm sorry, on page 6, we look at the total fund results that was also mentioned in Mark's executive summary. But for the quarter, as I mentioned, a positive return. I'm looking at the 2 large retirement plans, net of fees, 1.25%. That is the beginning of your new fiscal year. So that's how we're starting the year. For calendar year-to-date returns of over 12%, so incredibly strong performance as a result of the first 6 months of this calendar year. And for 1-year returns of 22.9% for PERS, incredible. So obviously we've been through some very good markets, a nice snapback from the COVID correction in 2020. And actually that has been accretive to even the longer term returns of 3, 5, and 7, even 10 years. You've had returns that have been around that 10% mark now for quite a long time. So we're certainly thankful for that. Relative to your benchmark.
Can I stop you real quick?
Sure.
When you hear people say we can't get to 765, just point that out.
Gotcha.
You've been there. So the benchmark, as you can see, when you look at that difference line, you've largely been outperforming that benchmark, which is terrific. And on a net of fees basis, really only the 1 year behind it ever so slightly, and 10 years ever so slightly as well, behind it by 5 basis points, but doing very well versus the benchmark. And when you're compared to other plans, again, this was in the executive summary, you remain highly competitive relative to the returns that other plans have been able to earn. Your asset allocation has worked extremely well compared to your index and compared to other funds. So for 1 year, you just missed the top third of plans. For 3 years, same story in the 32nd percentile for 5 years, 17th for 7 years, and for 10 years, the 14th percentile. So terrific performance. We think the benchmark comparisons are much more important, but it's helpful to know what other systems performance has looked like. And I'll have you flip ahead to page 9. Asset allocation is the driver of performance. It's the largest component and also of risk. When we look at your structure compared to other plans, we had this discussion a little bit ago, comparing you to endowments and foundations. But at the bottom of this page, you can see the allocation, for example, to US equity is on the left-hand side near the bottom. You have 30.7% in US equity. The median plan has 25.96. So you've been very much pointed in the same direction that has been the source of the best returns as we look at the last few years. And the non-US markets, you have 17%. That's a little bit above median compared to your peers, whose median is about 15.7. US fixed income, you have basically the same allocations overall in fixed income. In US, you don't have a dedicated global, well, you have an emerging market debt manager now. That's part of your structure. But you can see here that you're fairly close in terms of total fixed income allocation. And your alternatives, we talked about already, about 20%. These are your private strategies, private credit, private equity being the biggest piece, very close to median here. And real estate, you do have a larger allocation to real estate than peers, and that certainly has been accretive recently. And we like the yield component of your real estate portfolio and the core investments that you make, and we think that will continue to outperform the fixed income investment grade market going forward.
Becky, I have a question.
Sure.
And if it's just noise, tell me, but
Mhm.
if you go to page 6,
Mhm.
and I know this is an imprecise way to look at it, but you look at our net versus our gross.
Yeah.
And, throughout the periods where we have it, we're at 55, 56
Mhm.
basis points.
Right.
But calendar year to date, we're at 30, we're at half that.
Mhm.
Will that pick up when it's a full
It's
year?
lumpy, and
Okay.
when you look at when fees are assessed, it can have an impact on
Okay.
that. Your marketable asset class managers, it's coming through on a regular basis. But your illiquid investments, it's not going to be as smooth. So the run rate is fairly consistent with what you've observed. And that 55, 60 basis points, CEM comes in and tells you about how your fees stack up. To other
Right.
plans.
And I know that that's not,
Right.
you can't do it by just subtracting one from the other. I get
Exactly.
that. But
Yeah.
it just seems like it's so small.
Mhm. Well, and one of the things that you've just done is you're gonna move that.
Right. We're
That
gonna, right.
difference.
But that wouldn't account for calendar year to date.
No,
It's just lumpy throughout the year.
it's lumpy.
Okay.
That's the very,
That's never-
that's the technical investment.
That's the
term,
technical
lumpy.
I can remember that. Can I apply it to other things?
We'll see.
You're the chair.
It all depends on context.
All right, sorry to interrupt.
No problem.
Mr. Chair.
Yes.
Well, we're on page 6, just
Yeah.
on the newbie here.
Mhm.
So looking at the top lines there, the PERS. So quarter to date, fiscal year to date, 1.25, and then the benchmark. Is that what other investments across the board have returned negative 0.3 or?
So that benchmark is a weighted blend of the markets that you participate in. And an
Okay,
index that represents each market. And it's not going to be real precise for your private investments because there isn't a great benchmark for those investments. But we do the best we can to try to represent the relative kinds of risks in those investments. So think of that as, this is a reflection of how you're doing relative to your chosen asset allocation.
Okay.
And market indications of how each one of those investments have done. So our goal, of course, is to outperform. When you look at that net of fees comparison, outperform your benchmark over time.
so the year to date, the
Mhm.
12.2, and then the benchmark 9.27, so we've outperformed 2.9.
Yes.
Okay.
Becky's point with those illiquid asset classes and those kind of, what I'll call fairly short-term numbers, there's a lot of noise
Mhm.
versus the
Gotcha.
benchmark in the shorter term. So you
Yeah.
kind of have to look out further to get, a better sense of it.
You could call it lumpy.
You could call it one.
Yes.
That's a
I feel
technical
like
term.
I'm-
Is that in that abbreviations thing?
No,
that-
we're gonna add it to our.
I'm going to live with that term for the rest of my career.
So not to dwell on it, beat a dead horse, but so if we look at the 5-year deal, get rid of the lumpy, does that help? So it's 10.62,
Correct.
the benchmarks. So we outperform
Mhm.
48 basis points.
Yes.
Yeah, okay.
Yep.
Gotcha.
And that is significant when you're able to outperform your benchmark even by 0.5%. Some of these markets are difficult to outperform using active management. So we're thankful for every basis point, especially when it's net of fees.
Thank you.
You're welcome.
Because the benchmark never is net.
Correct. And yet we have to pay money to buy the benchmarks, to buy the benchmark exposures. But yeah, some of those markets are very inexpensive, others not as inexpensive.
So Dan, so when I can go back and tell them that you guys have outperformed.
Absolutely.
Yes. Absolutely.
Despite any opportunity cost that may be built
Carry the
into
torch.
Okay.
Right. So let's move to page 11. And we've just looked at some shorter periods, some longer periods. Let's look at risk and return for 5 years on page 11 on the left-hand side. You see on the upper left-hand side, what we call the risk return trade-off. So what this is showing you is risk, and that's how much returns move around, and return, which is vertical. So risk is horizontal, return is vertical. The ideal place to be would be up and to the left. So to have more return and less risk if we can manage that trade-off, and you have. When we look at compared to your benchmark that we just discussed, that's the blue dot, you have significantly less volatility than that benchmark. Some of this is a mismatch compared to the actual investments in the private portfolio. So that is some of the source of that. And you can see relative to those gray squares are other public funds. Those are other public funds that are greater than 3 billion. They're your peers. And so when you look at where your green diamond is for the PERS plan, for example, you can see that you're to the left of the median plan when it comes to risk. As you look at left to right, that's horizontal, that's risk, and you've gotten more return. So you've been slightly less volatile and have outperformed. So versus peers and versus your benchmark, you've had very good risk-adjusted results, we would say, on this page. No reference to lumpy at all. Another thing that I thought we don't necessarily talk about each time, but the Sharpe ratio is your risk-adjusted excess return. How are you doing when you factor in risk to the equation? And that is the second bar from the left. And if you ever want to know the definitions of some of the terms that we use in this report, they're at the end of this report. There's a glossary. And hopefully that'll be good when you're remembering some of the commentary and want to reiterate it. But the Sharpe ratio is a risk-adjusted excess return comparison compared to other plans. You rank in the 31st percentile, which means that you've done better than most other plans when you look at the excess returns that you've generated and the risk that you've taken to get there. So that's a very good measure. Now I'd like to look at those same two things for 10 years on the next page, a very similar story. So this is 10 years. This is a longer period of time here. And when you look in the upper left compared to other plans, which is the gray squares, and compared to your benchmark, which is in blue, you're in a very, very similar situation. So this is something we're consistently really happy with, that we're generating returns that have been attractive relative to both comparisons, but we're not adding risk to get there, which is a very nice result. And that Sharpe ratio that I mentioned, it's in the 18th percentile. It's just nice to see that up there in that top quartile compared to other plans. Any questions on that? Maybe in the interest of time, I'll skip ahead just a little bit. And just remind you on page 15, the cap pool that most of our long-term funds are invested in, that's really explaining a lot of the return results for the retirement plans, for example. This is just a reminder on page 15 what that cap pool is made up of in terms of its asset allocation. So domestic equity is 31%, international 17%. We went over those results relative to peers. So your overall equity allocation, public equities is about 48% or so. And you've got 15% in private investments, fixed income 20, et cetera. So this is just reminding you the cap pool specifically, what the allocations are. With that, I'd like to move to page 16 and just show you, again, this was in the executive summary, but I've got just a couple of observations to pass along. So on page 16, we've got the asset classes. When combining all the domestic equity allocations together, you can see what the return has been for the quarter. It was a whopping positive return of 14 basis points ahead of the benchmark. For the calendar year to date, a 16% rate of return, and for 1 year, almost 35%. Again, this is where all the cautionary notes come into play, saying please don't expect that continuation, because think about what this 1 year is. It's capturing a lot of economic activity picking up.
It's
No?
in his eval.
Oh, okay.
That's his benchmark.
All right. Well, no pressure then. So when you look at longer periods, though, for domestic equity, you still see some very above trend numbers, we think, relative to the very long-term history of the domestic equity market that will take it. Now, obviously, there is some transitions going on to move to passive as we look at the after this quarter. So I won't spend a lot of time on domestic equity specifically in this report. International equity, we did see a little bit more difficult markets there. Some of what was going on is China kind of moving away from, the more free market direction they were heading towards a more constrained environment where they're taking control of certain sectors of the economy. And there was also concern about the world's largest real estate developer defaulting and restructuring or having their debt restructured. So there was more worry in the international equity segment and also the strength of the dollar. So we did have negative returns for the quarter, but calendar year to date positive, and 1 year 24%. Versus our benchmark, underperformed in the nearer term, but the longer term, the numbers are above the benchmark, as you can see. So no near-term concerns here, but obviously the extent to which you had emerging exposure coming through in some of your manager portfolios, as well as the value growth kind of going back and forth, depending on how long a period you're looking at, was certainly some of the explanation there. Core fixed income, we are in that period we knew would happen sometime, which is rising interest rates, and it really hasn't happened much yet. But as the Fed looks at the environment and as investors reflect their opinion about inflation going forward, we have seen the impact of some rising interest rates, not so much for the quarter, but that core fixed income portfolio calendar year to date is down 1.6. Again, this is not due to any problems with the internal portfolio or Reams as your manager there. It's just a symptom of what's going on in those markets. And also, I think a nice reflection on what John had communicated going forward, actually trimming that allocation back a little bit going forward. The non-core fixed income here added some returns. It was really helpful as you look at the higher yielding components of the fixed income markets, as well as recently adding emerging market debt and preferred securities, a number that is positive for both the quarter and calendar year to date. So having these two components of your fixed income portfolio, we're very happy to have that higher yielding non-core fixed income to help bolster returns. Although you'll see the returns have been below the benchmark for some time, it's been a tough time for high yield managers when you look at the broad high yield market really outperforming over long periods of time. Again, there's some difference in returns by manager, but here it's been a bit behind the benchmark. We tend to see the opposite happen when we see a flight to quality occur. Real assets, very welcome component of your portfolio. This was previously called the natural resources component of your portfolio. A 2.4% rate of return. That, along with your private investments in real estate, actually were the big stars for the quarter. When you look at calendar year to date, also very strong returns for real assets, real estate, as well as private investments. So again, as we sum up the quarter, there was a lot of worry in the market, certainly in the fixed income markets, seeing some negative returns, but for your portfolio, you've got two pieces of your fixed income exposure, and the non-core pieces really helped. The rank for each one of those segments is on page 17. When we look at other equity funds, other international equity funds in our universe, as well as fixed income, and then real estate, you can see how the rankings have trended. Again, you've been above median in domestic equity. You've had a lot of indexing in place in that portfolio. That certainly has been accretive. International equity, your rank hasn't been as strong. Again, some of the emerging market exposure has certainly been a function there. And some plans have had much less emerging exposure, have EFA, more EFA-like exposures rather than an all non-US exposure. And so over this period, especially when we saw the correction in the Chinese stock market results, that was a big impact there.
Becky, does that metric capture like plans that do what they might call global, which might
Yes.
include US, which
It's-
US has done so well?
It's so frustrating that some plans just classify that as non-US, and that's not appropriate because it'd be a wind at their back if they're picking up the US equity markets.
Yeah.
So someday we hope that others will be a little bit more precise. Other plans are a little bit more precise about how they count those allocations, but that is a very important part of that observation. Also keep in mind, when you look at the core fixed income portfolio compared to other core fixed income portfolios, your portfolio is more core than most because you have the large internally managed portfolio. You have Reams alongside, that's a smaller piece, and you have your non-core or value-added components sitting outside in a separate composite. So a lot of plans will just throw all that together into one. And when you do this ranking, it just screws up your relative comparisons. You're doing things for the right reasons. Others have that combination for other reasons. So I just want to point out, you don't have a persistent pure performance problem when we look at your overall fixed income portfolios. It's just you've divided it a little differently. And then real estate, doing very well compared to other plans' real estate segments. I was going to quickly just go to page 19. A lot of times we don't cover as specifically the trust accounts, but I just did want to point out it's a sizable portfolio at 8 billion, and the larger components are a significant component. The treasurer's fund and the state insurance fund as well at just under or just over 1.5 billion. So in the interest of time, I can stop right there, or I can answer any questions that you had about managers or other components. But it was a fairly quiet quarter in terms of the magnitudes of returns, but it was positive in a period of worry. And as we passed 9:30, the equity markets have continued to advance. So hopefully investors will keep that positive sentiment as we close out the year. But we have a full month to go, so.
Questions? Cliff, how are we doing? We skipped the break. It is time for a break, but and are you
I'm
you're
here.
sticking around?
Yeah,
Okay.
I'll be here. the
Why don't
rest
we do that? Why don't we take, where are we here on our agenda? I kind of
Okay.
lost track.
We're ahead of schedule.
Do you want to take 15
Sure.
and come back at 2:45? How's that? And then we'll probably some questions. Get back to work here. Recording is in progress. So questions for Becky? Questions for Becky? No. Nobody wants to talk about benchmarks? Well, I'll ask Jack's
Lumpy
question, which is,
benchmarks.
what do you see as the problems?
Oh. Oh, so the Jack
very astute
question?
question.
Yeah, the Jack question.
Yeah, We want to talk about domestic equity, obviously, because that has transitioned. I think that as I looked at international equity, I didn't see anything that was persistently underperforming or as a concern when I look at the composites. So that's something, obviously, you've had some managers that have been, having difficulty, like Invesco, for example, over longer periods of time. You've had some value managers that in some cases have snapped back in the last 18 months, last year, when values started to do better, but something that we had certainly watched. The points I was going to make on fixed income already did, not wanting you to be concerned about the bifurcation of your fixed income when you look at performance results. That's not really an issue. When I looked at Reams being your active manager, they really are truly an active core plus manager and have done well over time. I think that's a very nice complement. And it's been in place for a number of years, but it continues to be a nice complement to the internal portfolio now that you've had the separation between the non-core and the core. Having preferred and EMD and the non-core, that will be a good, interesting space to continue to watch. I'd mentioned that preferred really added value this period. Emerging market debt is going to be important over time as you continue to try to find yields somewhere, especially until the US equity market yield environment changes. So that component, I think, will do well, but just be prepared. That's going to be a volatile asset class. Whenever you see panic in the world or concern, that's one of the asset classes, along with emerging markets equity and small cap in some cases, where investors will just sell off the asset when they're looking for a safe haven. And it's not because there's anything wrong with the asset at all. So there aren't any big screening issues in the portfolio at all because you've done such a good job in structuring it and putting the managers in place. And with the movement to entirely passive in US equity, these reviews will be a little bit more quick because that will just be a reflection of following that particular structure decision. So long story short, there isn't anything that's unduly concerning. And the managers that have underperformed recently or more persistently, we continue to watch. We don't go over those sorted, the managers sorted pages that are a unique part of your portfolio. And the pages that I'm speaking to, let me just get to the right pages. They're good reference points, but we rarely actually go over them. If you look at, for example, get to the right page here. We go through, oh, I'm in the wrong book. Would help if I get to the right one. If you look at, for example, page 27, this is just interesting to note. This is some composites of equity styles in this case. And I just want to note that they're there for Representative Walsh. This is something that is entirely unique to your performance report, where we've got a list of the components of your portfolio and how they've done since inception, just so you know, because it's hard to, at times, follow a trend if you're just looking quarter to quarter, quarter to quarter, or year to year. This one actually shows you since inception for your equity portfolios, and it's dividing them up into active, into value and growth, into international and US. And it's interesting when you look at the sort versus the benchmark. One of the domestic components of your portfolio that has struggled for quite a long time is mid-cap. And again, you've made a decision to eliminate that particular issue. And international active, some of the value orientation and some of the managers that you have in value is some of the reasons that you're behind the benchmark there. But, for the most part, there, when we look at the manager or the composites that are outperforming the benchmark versus those that are lagging, there's only a few that have a significant lag since inception. And some of them, the relative performance has definitely picked up in more recent periods. And then we've got actually managers information that's sorted a very similar way. And that's just interesting to look at, but nothing that is leading to a comment or observation this particular quarter.
So when you look at 27 and you look, you go to the bottom and there's international active.
Yep.
Since inception,
Mm-hmm.
not particularly great returns and not particularly good returns against the benchmark.
Let's.
So why? Why shouldn't the board be saying,
Mhm.
let's do something about that?
Well, if you'd like to look at, let me get to the right page here. Let's look at international equity in a little bit more detail. And we'll show you how the composites are done over different periods. So let's look back to page 24. So this is one of the things that I look at when I'm digging into questions like you just asked. One of the things I look at is since inception is a very long period of time that actually captures a lot of changes in this portfolio through time. It captures the time when you move to having a bigger passive component. During this period of time, there's been quite a lot of manager changes that have occurred during this period of time. So a lot of that can get lost in the since inception. So what I do is I look at the international equity active net line, which is the third blue line. This is showing you compared to that benchmark, how's the more modern performance playing out in that particular composite. And you can see here that you lose a lot in looking at just since inception. When you look at for the last 10 years, you've outperformed versus the benchmark by 1.8% with your active managers. So that's why I don't have concern with that particular chart, but it does cause you to ask the question, when did that underperformance occur and what's it look like today,
Right.
given the current structure?
But one thing to just add to that too, you know, I agree with Becky, and you know, my personal view is I can't understand why it's easier. Well, I mean, I can intellectually understand why it's easier in international to outperform, but it seems like it shouldn't be that way. But you know, you have over a long period of time, so it does seem like it's one to watch closely. And if it starts looking like U.S. equity, then yeah, it may make sense to do something. The other thing is, and we talked about this at the orientation and meeting last time, for good reason, for sensible reasons, you're making a bigger move into private assets. The rewards, the potential rewards there are higher. If you get good managers, you're going to do a lot better than if you get bad managers. But you know, on the flip side, that there's risk. If you get the bad managers, not the good managers, the opposite happens. So that's not a problem, but it's as you increase allocation to that area, the amount of scrutiny and due diligence, you want to turn it up a notch. And it's especially important now because you're not the only ones that are looking there. So the competition for the best managers is going to get more heated. So, you know, it was funny after Ethan presented either one meeting ago or two meetings, and Ethan can vouch for this. I sent him a quote, and this is a compliment to Ethan, by the way. I sent him a quote that I think it was from John Kenneth Galbraith. When people are cautious, questioning, misanthropic, suspicious, and even mean, they're immune to speculative enthusiasms. That attitude is going to get more and more important by the day as competition increases in these areas, and embrace it because it's a compliment. I'll
You
close
give
with that.
compliments like my grandmother used to.
You're wondering if you should feel good about it or not?
Right. I still don't understand why it's a compliment, but I'm not going there.
Yeah.
It is you want people like that on your staff. It is a compliment.
Got it.
Yes. Any other questions I can help with or pages you have questions about?
Anything else? Thank you.
Thank you.
It's nice to see you.
It's good to be here.
Yeah.
Thank you.
Well, it was fun to see your house.
Yes.
So we tab 6.
Tab 6.
Do I have that right? Okay. I lost track of it.
Tab 6, investment update. So I will kick it off, I guess, here as usual. So I am on page 4. The typical asset changes slide here. So as it's been talked about, a pretty darn good year. Dollar value add about 2.8 billion versus a net cash need of 432 million.
You don't like it?
Brings us up to about 14.6 billion in total assets at the end of the period. But the more important numbers really are the 5 and the 10. You can see that we've handily added substantially more to our assets than we've had to send out the door to pay benefits over the last 5 or 10 years. So that is a good thing and where we would want to continue to be. That 1 year number will tend to be volatile. We can remember last year during the our assets drop and we still had to send money out the door to pay benefits, but over the long term, we hope that's not the case. Slide 5 is the breakdown within the different asset classes of the cash flows over the course of the year and the change in the value of those assets. So as has been typical over the last few quarters, you can see that domestic equity has kind of been the star there, and those assets have been going up significantly, and so that has typically been what we have tapped to either pay benefits or to rebalance. The other areas here have been, core fixed income was an area that we reduced a little bit for obvious reasons and reallocated other places. And then international equity did reasonably well. And private investments, as Michael has mentioned a few different times, have had a lot of realizations over the last year, as it's just been a very good market for the private managers to sell off assets that they may have bought previously and garner a good price. And so that's resulted in quite a bit of cash flow back to us, more than might be typical. Questions with any of that so far? All right. Next slide, slide 6, is really just the same look, but broken down by the plans themselves. Obviously, PERS and TRS are the large plans there with the largest cash flows, different than normal. And then on slide 7, performance, so 22.9% for the year, pretty good. And as we already talked about earlier, the long-term numbers in particular, meeting our actuarial hurdle across the board, pretty much any time frame there. So that's obviously the most important goal at the end of the day. Questions on any of that? All right. Slide 8, individual returns for plans, but also all the different asset classes there. And as you can see, everything has contributed to very good returns over the course of the year, with, I guess, the exception of core fixed income and cash not having much yield to it at this point in time.
Mr. Parentheses.
Yeah, next year, that's right. When all of those are red and you're green, you'll be in here gloating, so. All right, slide 9, just the breakdown of our midpoints and how far we deviate from those one direction or the other. Pretty spot on for the most part across the board, no real significant deviation there. And actually, if you look at those, I think as we talked about before, so you approved the new policy, so up 1% in real estate, or virtually already there, down 1% in core fixed income, a long ways there. A little more to go on non-core fixed income and down 1% on cash, basically there. So, we'll remain pretty spot on to our new midpoints. Questions on any of that? All right. So to the economic environment, slide 10. I feel like each time when I do these, it's really kind of variations on a theme. Don't tend to have a lot of different things to say each quarter, but try to pick out something that's interesting and probably follows along with a lot of Mark's comments earlier in terms of inflation and things. But you know, one interesting data point here is the unemployment rate certainly dropping and probably at a level where we would typically say, well, that's a pretty low unemployment rate, and it is, but we still have 3.1 million fewer people in the labor force from February 2020 to now. And that is, you know, kind of part of the reason we have such a low unemployment rate is because we have not pulled all of those people back into the labor force at this point. Obviously, a significant level of debate as to whether or not we ultimately get all of them back into the labor force. You know, some may have retired early and things like that, so they may not be coming back. Others may have changed their lifestyle or gone back to school for an extended period of time. So, you know, kind of to Mark's point about some of the inflationary impact here of, you know, pushing wages up because we don't have enough workers, and that's going to take some time to correct. It's not necessarily going to be an overnight change, but it will happen over time. And so, you know, I think his 1.5 to 3 year time frame for sort of some of the transitory talk that's out there, you know, may very well be accurate. And that doesn't feel real transitory when you're in the middle of it, as I think that is starting to figure out. Page 11, you know, I could have picked a million different things here in terms of kind of the idea that demand has surged, but I like the global shipping costs, you know, spiking here. And you can see that they have started to ease a little bit as we've, you know, picked up activity in the ports and things. But again, that takes time to move that needle. And so they haven't come down a whole lot, but I guess you could argue that maybe the bottleneck is starting to ease a bit, but certainly, you know, extremely elevated over what they have been over the last couple of years even. Job openings similarly, you know, basically a multi-decade high here in terms of job openings. And I think it's kind of interesting. So that's, you know, call it roughly 7% of the labor force. Maybe 3%, 4% would be, you know, kind of typical unemployment rate. So again, you can kind of almost take that 3 million people that have not come back into the labor force and sort of understand why the, you know, level of jobs is so high, because we just haven't been able to find those workers. Page 12, real returns in treasury bonds. Moscow complains about it almost every day. You know, how can we have negative real returns for as long as we've had, which hasn't been that long, but it is true when you look back over a longer period of history, you don't tend to have negative real rates of return for extended periods. And yet there doesn't seem to be a whole lot of movement there yet. Kind of keep waiting for that to snap back. And so when I'm talking about real rates, you know, so the 10-year treasury right now yields about 1.5%. Inflation expectations for the 10-year time frame, if you look at the TIPS market, is about 2.5%. So you're basically buying a 10-year treasury bond today, if you are, and you're saying, I am going to lose 1% of my purchasing power over the period that I'm going to own that 10-year treasury bond. That doesn't make a lot of sense. I mean, basic economics over a long term would say, you know, okay, I've got, you know, certain, you know, nominal rate that I want to earn over and above inflation, because I at least want to be able to buy the same goods and services with the dollar that I invested, you know, today in the future. I don't want to lose purchasing power. So it's I'd say a conundrum that the market is wrestling with, and the answer is essentially that, you know, the Fed continues to hold rates down. And you know, I guess like a lot of things, sometimes the market can be irrational longer than you can stand to be on the other side of that trade. And you know, you don't know exactly when that's going to break, but it's certainly something that we're keeping a close eye on, I guess. Slide 13. You know, Mark certainly talked about the central banks here, and I, you know, including the Fed in that, but it's a global phenomena that everybody, all the central banks have pushed a lot of liquidity out into the market for good reasons, in some cases, to try to help us support ourselves during COVID. And they're starting to pull back a little bit. So, you know, I guess it was the last Fed meeting here, and I'm trying to remember, maybe a month or so ago, I guess. You know, the Fed did come out and say that they're going to start dialing back their purchases of treasuries and mortgages in the open market by a small amount. So they're dialing that back by what, 15 billion, and they're currently buying 120 billion a month. So it's not much, but it's a first step, and the market has kind of run with that. And so they're trying to project out, well, when do they actually start raising rates? You know, if the GFC is any guide, it could be quite a while. That was a very, very slow process at that point in time. And I think, you know, probably when I wrote these slides, it was looking like maybe they would pull that forward and raise rates quicker. And now you've got a new, you know, variant of COVID out there in the market. And so that adds another element of uncertainty to what they're trying to accomplish, because they want to help support the markets. And so if that, you know, flares up or becomes more of a headwind for the overall economy, maybe they don't raise as quickly. If it turns out to be, you know, not as dire as they think and the economy heats up, I think they will, to Mark's point, the Fed will adjust to what the market is going to do. I don't think they're going to let inflation run away. But that also, it puts the investment side in a tough place, because you're trying to, you know, guess what the Fed's going to do. That is not an easy game. Slide 14. Just something I would note here, because we're always talking about how expensive things are, and it's true that, you know, most risk assets are pretty expensive, but we have gotten to a point where U.S. equities, you know, particularly kind of being the safe haven over time, have outstripped international equities to a degree that some would argue is relatively extreme, but it's not. It's also not that international equities are dirt cheap relative to history either. So, you know, there's some good reasons why the U.S. may have, you know, run with that, but it's, I think, notable. And so have made an effort here, probably more recently in the fourth quarter, not that it's paid off in the near term, to, as domestic equities have run up, we have sold some domestic equities and bought international to at least try to keep ourselves close to that midpoint, because I think there's a danger there that, you know, maybe the U.S. is a little more susceptible to a pullback should things open up again. People get a little more optimistic and start looking around for value. So slide 15, just broad update here, I guess. You know, lots of investment challenges in the current environment. Clearly, I would have put the Omicron virus probably on this list at the top had it been a thing when I wrote this page, but it's there now. As we talked about, you know, uncertainty around, I think, monetary policy, fiscal stimulus that we talked about in terms of the infrastructure bills, both the one that they've already passed and the kind of the Build Back Better bill. I think tax policy is a reasonably big issue in terms of possibly raising rates on corporates in the US and globally. As we got to that more recent global tax agreement, we may see, you know, some increased pressure on corporations globally there. And then inflation expectations are clearly not, you know, agree with Mark. I don't think long-term the Fed lets that be a problem, but, you know, I think it's likely that inflation runs a little bit hot here, and kind of determining when that, you know, hotter inflation over the short term ends, whatever the short term is, you know, is a little tricky for sure. Already we have mentioned it, of course, but the restructure of the domestic equity portfolio, as you all know, decision to go passive across the board there. We are almost done with that transition, 99.99% basically. Just a few additional securities there to trade before we're complete, and we will have a full cost report of that at the February meeting once SSGM gets that to us when everything is complete. And Jason will talk about a little bit more when he does his portion as well. Continuing to look at new public and private manager opportunities, of course, across the board. Was on a visit with Ethan a couple of weeks ago, where we had a little marathon trip to New York and Kansas City, and so looking at a manager there and within the real assets portfolio that should be pretty interesting, that we hope to bring you and see what other ways that'll be in the hopper as well. We are searching for a new private investments analyst, so that posting is out there currently. It ends at the end of this week. Did some work on it this weekend. We've got 26 resumes, I think, out there, and I would say there were a handful that were interesting. So we'll be figuring out, I guess, kind of first screening and some Zoom interviews or something, hopefully early December, and then see where that goes. And in addition, we've got posting out there for interns. Have contacted, I think, all of the universities at this point around the state. Got some applicants out there, but that one doesn't close until January. But reaching out to the universities to try to drum up as much interest as we possibly can there. Kirsten and I actually went over to MSU, I guess it was beginning of November. Time flies at this point. Taught a class for one of the finance professors over there, just broad overview of MBOI, and Kirsten gave them the fixed income bond world stuff, which was something that they were working on at that time. So hopefully all those types of things help. Looking to do something similar at U of M if we can make something work over there.
And tech.
Of course. I'm waiting for our distinguished alumni to, set that up for me. Point at Maggie, but
I probably have more connections than he does, sorry.
fair enough. We'll talk. Tons of projects in the hopper. Dan's mentioned the custodial contract. That's of course taken a ton of time. A bunch of other stuff on here. I guess maybe the only other one to note anything about would be the improved trading capabilities. We have set up, Tim and Jason have worked on setting up trading ETFs through the Bloomberg system electronically, so that we can put 3, 4, 5, 6 brokers in competition whenever we trade ETFs going forward. So we haven't really had a chance to pull the trigger on anything here, but we'll probably do that shortly, just to kind of make sure everything works as we expect it should. So that was some previously, just I guess for color, we only went to one broker and did that trade with them, I would say more manually. So I've set it up to do it digitally. Yes,
ETF means exchange traded funds. So
correct.
So when it's going on the exchange, so why would having a different broker make a difference?
So we'll put them in competition.
So they're just looking for the best execution.
Best execution. Yep, absolutely. Yep.
So John, how long are your student interns? Do they just work during the summer?
So we actually put the posting out there so that we could take somebody for like this next semester. I don't know that we will necessarily get anybody for that. Typically, what we've always done in the past has been kind of come in May and you're done in August or so, something like that.
That's how it works on the investment side. If you're an accounting intern, you're here for 5 years and minimum.
We don't let you.
Right, they lock them in.
Yeah. That's right.
That's that locked door back there.
Fair point. And apologies that this says June 30th. I didn't, it obviously was September, but I missed it.
The private investment analyst.
Yeah.
One more time, it closes when?
Closes the end of this week. I can't remember if it closes like Friday or Sunday or something like that.
Okay. And you've got, from what you see now, you've got some interesting candidates.
Yeah, I thought we had a handful that would definitely be interesting to talk to. So. And hopefully we'll get a few more by the end of the week. any other questions for me before I turn it over to Aaron?
Aaron?
It's been a while since I've been here in person for you, so it's good to be back. Good to see you again. There was a question earlier about our exposure to PG&E currently. Right now, we have about 1.5 million passively held in our domestic equity asset class. So relatively small exposure. Getting right into the macro attribution key takeaways. Our policy neutral strategic asset allocation return was about 23% this year. As John mentioned, core fixed income was the only negative contributor, with domestic equity being once again the largest positive contributor, of course, due to its large size within the pensions and its strong return. The private investments asset class did have the largest absolute return. Within tactical asset allocation, the effects were again relatively small this quarter. So looking under the hood a little bit more of that, we were slightly overweight to international equity and domestic equity, which had strong returns. So that added quite significant positive impacts, but we were slightly underweight private investments and real assets midpoints. And while they have public equity indices, when those have very positive returns, we're going to have a slight negative impact there. So those kind of cancel each other out. It was relatively small impacts again. Within style selection, there's not really a lot to note this time around. My key takeaways are almost exactly the same as last quarter. And overall, there was only a 2 basis point effect at the pensions level, so pretty small. Within manager selection, there was also not a whole lot of contributions here. Outside of a few takeaways I have in the presentation here, one thing I note is that for private investments and real assets, from October to March, they showed pretty poor manager selection effects. And from April to September, they still showed pretty exceptional manager selection effects. And I think it's just a good example of that lagged pricing effect that the private asset classes have versus their public benchmarks. So it kind of whipsaws. And so their selection effects were also very low. I think the lowest you'll probably ever see them, almost coincidentally, very low for this 1 year period. Real estate was slightly a different story. Again, its underlying benchmark is lagged, so we're not going to have that whiplash effects. And our real estate asset class was a strong performer versus benchmark this year. If no questions, that's all I have for macro attribution. Thank you.
Afternoon, everybody. How's my audio?
Good.
Okay, I'm on page 19. We just did the private investments deep dive in the last board meeting, so I'll keep this pretty short. Private equity deal flow was very strong for the quarter and also year to date. Looks like it's going to be an annual deal value record year just through 3 quarters. That's something that we have been anticipating and would expect going through the next quarter or 2. Valuations on bullet 2, seeing high valuations. This has been the case for the last couple of years. It doesn't look like it's that much higher than the 10-year average. It's because the 5-year average has been exceptionally high. And so if you go back to 5 years prior, it's a bit lower. So we're in a high valuation environment. Leverage has been hovering around 6 to 7 over the last couple quarters. Bullet point 4, fundraising. This is a newer development, but we've been discussing it with the board over the last couple quarters. Fundraising has been quite strong definitely rebounded from 2020. We're seeing managers coming back to market and raising quicker than expected. I think historically we had forecasted more of a 3 or 4 year cycle where managers are coming back to market. And now it's more like 2 to 3 years. And you can see that in our board briefs where you see the string of funds, and it's usually 2 or 3 years between funds instead of 3 or 4 years. So managers are deploying faster, realizing companies faster, and so they're fundraising faster than historical. I'll pause there for any questions.
Is that a good or a bad thing?
It depends how you look at it. In the case of recent performance, it's been exceptional, and so it's been a good thing. At some point, the tide will turn, and there will be an excess of dry powder that doesn't get deployed, and a lot of competition, and so that could create negative effects. But currently, it's been positive in our portfolio, across the portfolio.
Thank you.
I'll move to page 20. RVK and John has already went through this. Performance has been exceptional for the last year across privates. That really applies across our portfolio. Our bio portfolio is doing very well, lots of liquidity. We expect that to continue over the next couple of quarters as our managers have hired bankers for strategic exits as well as IPO. Our private credit portfolio has done exceptionally well. That's really taken a barbell approach. Our senior credit has done what it's set to do, even during COVID, and that's a low double-digit return. Our distressed credit portfolio has done very well, and that's 20 to 50% types of IRR this past year. And so I forgot, VC has also done very well. And so, across the portfolio, it's been excellent performance. I'll pause there for any questions. Moving on, page 21. First 3 bullet points are just some statistics on the portfolio. Cash flow. Positive cash flow for the previous quarter. We've actually been in a positive cash flow for the last 4 quarters. It's been a great time for exits and liquidity in the portfolio. John mentioned it earlier, but we've actually gotten close to $500 million back from our privates portfolio in the last year. Liquidity has been very high. And we would expect that to continue over the next couple of months and through the beginning of next year as well. 2 new commitments. Crescent, we presented last time at the previous board meeting. Kinderhook was presented earlier today by Thomas. We have 1 more deal that closed last week. Altogether for 2021, we would have committed $450 million of capital, per some of the pacing that John mentioned earlier to the board. And that's all I have, unless you have any other questions. I'll turn it over to Ethan.
So I have a question. We the direct primary fund exposure, 77% versus funds of funds at 23. Are we, I know years ago we talked about bringing the fund to funds numbers down, and I think we have over time. Do you anticipate bringing it down below 23%?
I think over time that will go down below 23. It's gone a bit higher as of recent. That's probably twofold. One of it is we have a lot of VC fund of funds, and they have done very well. We're in some great vintages there. And so the portfolio values for our VC fund of funds have gone up a lot. And so that's driven an increased number. The other reason, which is a little bit more direct, is that we focused on our relationship with Axiom Asia, which is our Asia fund of funds, one of our largest exposures in the portfolio. And so between the VC fund of funds and our increased exposure to Axiom Asia, that number has gone up to 23. I think over time, this number should decrease because we have not been actively growing our fund of funds exposure. And you really haven't heard of that in our recent commitments the past couple of years, with the exception of Axiom Asia. Good question, Carl.
Astute, right?
Very astute.
Very astute.
Thank you all.
As opposed to lumpy. So, I mean, so that 23, 20, 20, 20, 20, 20 to 25, is that where we're sort of shooting at for fund to funds, or are we not
It's
taking it deal by deal?
It's very bottoms up, but the numbers should go down. We have a lot of legacy fund of funds, and that kind of sticks around. So that portion should go down because we really haven't done any diversified fund of funds or any other fund of funds except for Axiom, which is our Asian focused fund of funds. So Axiom's number will go up, but it won't be 23. And then all our legacy fund of funds exposure should go down. And so, you should expect that number to go down over time.
Okay. Thank you.
Thank you.
Anything else for Michael?
Oh, one more thing.
What's
I
that?
just wanted to address Mark Berry's question on OCP earlier around the performance for Fund 4, that negative IRR. That's really just a J-curve effect. That number should increase over time. I would also note that the performance number shown on OCP is also 331. And so at 930, the numbers have all gone up. And so the performance shown in those historical funds is not really indicative of our target returns for OCP. They're quite a bit higher than what's shown. And that negative number is definitely not applicable. It's really just a J-curve effect of them calling down capital and fees. And so we would expect, much higher returns across the board for OCP as a target return.
Got it. Thank you.
Thank you.
All right. See you, Michael.
Hi,
Hi.
I am on page 22 to cover real estate. And I just might draw your attention to the final bullet point. The recovery in real estate is pretty much in full swing across the board, across property types, across markets. Variations certainly persist or exist, but debt is widely available. Bankers are loosening constraints. REITs have performed. Delinquencies are down. Dry powder is healthy. There is healthy competition in the market, which is supporting pricing. There is healthy demand. Rents are going up. Occupancies are going up almost across the board. So that's the main takeaway. Of course, yes, Terry.
Is that true in office occupancies?
Yeah, that's gonna be my question.
Yeah, it depends. So suburban has experienced some significant demand actually, as people have sort of left the CBDs, the central business districts. However, depending on the property, in fact, I just was on a annual general meeting today with one of our largest GPs in real estate, DRA. And across the board, their office occupancies are up. They're signing longer leases, which was shocking to me, to be perfectly honest. But there is certainly some distress that I think will continue to play out in office probably over the next 12 to even 36 months. There are some folks that say office is highly overvalued on the order of 10 to 30%, depending on who you talk to. That is all going to play out with the virus, with work from home. In central business districts, I was just in New York last week with John. I was in San Francisco the week, or actually the same week.
Same week.
Oh, it was a crazy week, the week before Thanksgiving. And offices were full. you know, our managers are reporting strong collections, strong numbers, but there is definitely some, you know, sublease space on the market. The sublease space in DRA's office portfolio is at like less than 2%, which is historically average for them. So, you know, and they own offices in CBDs and in suburban locations. So, again, to my point, variations exist and more so in office without a doubt. So great question. Thanks for pinpointing me on that. You're absolutely right, without a doubt.
And
Did that answer your question? I'm sorry,
Yep.
Mark. Okay, great.
And what about warehouses?
Warehouses, never seen anything like it. They are full. They are, you know, occupancies are at historical highs, vacancies are at historical lows. I was in Savannah, Georgia, for example, in the beginning of October. Savannah is a gigantic port, as you are no doubt aware. Looking at some of our warehouses and logistics-oriented properties that we own through Stockbridge Niche Logistics. And I was just, I had never seen anything like it, Mark. Yeah, trucks were in and out. They were parked. I mean, it was just nonstop traffic. The warehouses were full to the ceiling. I mean, the consumerism in this country just was baffling to me, but it was full and operating and just operating full tilt.
Is that rebound or is that because of supply chain?
Kind of been like this for a while now. I think it's become a little bit more acute because of, you know, the online e-commerce supply chain issues for sure is compounding it, but this trend has been in effect well before the pandemic.
And I think you have some onshoring coming, you know, people realizing that, hey, I should have inventory here rather than sitting in China these days or wherever. And so that in addition to the already, I mean, industrial was already hot. And now it's just.
Yeah, rents in industrial, I think we're up 12% last year, like 6% last quarter alone. Rents in multifamily were up 18% last year. I mean, unheard of numbers. Multifamily occupancy is at an all-time high, like over 96%, depending on whose numbers you look at. It's been crazy.
The
Retail still struggling a bit, you know, so delinquencies, CMBS delinquencies in retail are at 8%. That's at CMBS, and that's down from like 18%. Hotel is at 10%, and that's down from like almost 40%. It depends on the retail. It's very bifurcated in retail. So grocery anchored, which is where a lot of our exposure is just done phenomenally well. But, you know, that sort of experiential walkable stuff is still struggling a bit, to be sure. Sorry, Carl, please.
Does the office retail, is that, are there big regional differences in the United States? Do you know?
Sorry, you threw me off with the office retail
I'm
comment.
sorry, office space. Are there big regional differences?
You know, yeah, I would say, I mean, you know, San Francisco to me was decimated during the depths of the pandemic, but it seems to, at least from anecdotally, from what I experienced in talking to some folks and just seeing, you know, I was in Embarcadero 4, which is right in the financial district, and it was bustling and everyone was in the office and it was hard charging. The streets were full, whereas, you know, 60 days ago, it was still, you know, crickets. But you know, I'm sure there's other office markets that are, it's definitely variable. There's no doubt about it. Seattle, Portland was still pretty quiet when we were there back in September. Portland's still very quiet. Seattle's very quiet. You know, I think it's dependent upon a lot of factors.
That has to be the case with hotels and stuff too.
Yes.
There are hotels in Montana that we oversee, the guy I work for. We're having a banner year.
Yeah, it's case in point. You know, I've been to some hotels that were just, I mean, the Courtyard in Manhattan was bustling. I'd say Kansas City was pretty quiet. The hotel I stayed at in San Francisco was pretty quiet. Very quiet, in fact. So it's regional, it's market specific, it's property type specific, but one thing is for sure, multifamily, industrial, grocery anchored retail, never seen anything like it. I don't think anybody, any practitioner has ever seen anything like it.
What does that mean in terms of new commitments?
It means that we will continue to focus on our highest conviction current GPs. That's not to say we won't look at other GPs, but specifically those that have, and I think this has always been the case, those that have proven their ability to succeed through cycles. You know, DRA, Angela Gordon, prime examples of that. Bell Partners in multifamily space, vertically integrated operator, prime example of that. Folks that, you know, aren't just, haven't just been around since the GFC, since the end of the GFC and had the wind at their backs the whole time. We look for gray hair and people who've been through cycles and shown levels of success through cycles.
Is COVID a cycle or is it a fundamental change?
That's a huge question. So, I mean, I think the COVID, it was a blip. I wouldn't say it was a cycle. Some people might call it a cycle. You know, these are opinions. Is it a fundamental shift? It depends on what you're talking about. I think consumer behaviors changed a little bit as a result of it. I think office use is going to permanently change. There are a lot of people out there that think it's going to go back to normal. I don't think it will ever go back to normal. You know, I know folks that are already buying offices and converting them into other uses because they're just sitting vacant, for example. So I think, yeah, it just depends on what you want to apply that question to. But I don't think COVID was a cycle. It was a hiccup. And I think there have been some fundamental shifts in the world.
I think COVID accelerated a lot of the trends that we were already seeing. Made it go faster. Probably, I don't know, that'd be my take on it, I guess.
Yeah, I was listening to something not all that long ago that said somebody was in real estate was talking about how COVID sort of coming out these last few months, if you will. I mean, it's still here and it's not going away, but has basically represented the start of a new real estate cycle for whatever that's worth.
What is that? I don't, what does
What does
that
that mean?
Just, you know, continued strong fundamentals, you know, favorable interest rates, you know, deep buyer seller pools, strong fundamentals, you know, increasing occupancies, increasing rents, good, you know, employment, good consumer behavior from a retail perspective, full warehouses, you know, you name it. That too. Yeah, absolutely. Yeah, that's an area I've been looking at for a long time and I just haven't found the right manager, and prices are getting pretty rich, but they're rich across the board. So again, to your point, it's about finding seasoned professionals that have been through cycles. And that's a huge focus, you know, like I can't tell you how many funds I look at that I just kill almost instantaneously because I'll sort of look at their vintage or, you know, they just started a few years ago and, you know, there's always a little bit of a story there and you can connect the dots, and we don't run from complexity. We just work to sort of understand it. But, you know, sometimes they're really easy to say no to. I like a long track record and a deep, rich history of connected individuals.
Thank you.
Sure. So any other questions on page 22? Where are we? Page 23 is performance. It sort of speaks for itself. I won't point anything out necessarily. I think we've had some strong performance of late. I think the last year has largely been driven by a lot of cap rate compression. That means prices have gone up, values have gone up, and you know, our REITs have performed well, and that's a pretty sizable piece of the overall portfolio. Seeing no questions, we'll go to page 24. Again, should be very familiar by now. US centric, continue to look for property type specific operators. Hoping to establish some separate accounts for longer duration holds and cash flow ultimately. We had a positive cash flow quarter. We covered OCP Asia. Here's our leverage profile. Everything is within constraints. Happy to answer any questions. Seeing none, we'll run on to page 25 and cover real assets. Again, the summary bullet point down at the bottom. This, again, I think I heard John say something. I would maybe say, rather than a positive outlook on oil, it's maybe a little bit tempered and cautious with the new variant out. Oil pulled back, I think, in upwards of 15% over the past couple of weeks. So, but notwithstanding that, it's still at 40% year to date, 65% year over year or thereabouts, rough numbers. MLPs have continued to perform very well for us. Good, strong yield play. Sawlog prices are up. Aggregates are strong. Housing market remains robust, but maybe finding a bottom or sort of stabilizing. Again, there's lots of dry powder out there. Happy to answer direct questions that are completely unrelated to any of these bullet points, but in the real asset space, please fire away.
Lumber prices now, they bottomed out. I thought they were super high and
They
then they
were.
went down.
Yeah, they've actually returned to like their pre-COVID levels.
Oh, okay, so.
Yeah, they spiked up from like $400 a board foot to like 1,400 or 1,500, and they're back down into like the $400 range.
Is that just because of the supply?
It's a supply demand thing. It's a combination of stuff, but it's mostly driven by supply and demand, Carl. There was a lot of speculation there as well, for sure.
Has timber been a good investment for us?
It's been steady for sure. It's a positively returning asset class. It's nothing, it's steady Eddie. It's great income generation. Hasn't been a lot of capital appreciation there, but no complaints. Very long duration. It's basically like a bond on a relative value basis. It's certainly outperforming treasuries and investment grade to some extent. If memory serves, our since inception return for the timber portfolio as of 9/30 is like 4.4% net. So, back when we initially invested in timber, it was meant to be a diversifier first and foremost, and then sort of an income and inflation hedge, and sort of capital appreciation was a low man on the totem pole. And it's done precisely that.
That's what I was gonna ask.
Yeah.
Comment I might add was, this quarter is lost track of time, but in the MLP space, we've got our MLP manager. Ethan mentioned, very high yields with the MLP space right now. So we actually went out to them and to State Street and said, we'd like to take our dividend yields there instead. We typically, most of those managers will reinvest, but we said, let's take our dividend yields there because we didn't necessarily want to add to the space, but we like the yield obviously at the moment. So we kind of made that operational change, I guess, and with parents' help and things too, obviously.
Terry had another question.
No, Ken had a question.
Oh, Ken has a question. I'm sorry.
Do we do any investments in like mining operations? Is that?
I'll start. Do you want to finish?
No, go ahead.
I'm gonna get my years wrong, but I think it was back in 1982 that the people of Montana voted to outlaw certain mining related activities as far as strip mining, acid leach mining, and so forth. And so as a result, because there's a much larger opportunity set in real assets, we have opted to avoid that type of exposure and sort of vote with our investment dollars alongside people of Montana and how they voted years and years ago, and avoid any consternation in headlines, frankly. But we've looked at a lot, and if it weren't for other opportunities, we would look at mining. But there's a lot of other stuff we can do, and so not having it in the portfolio certainly has not been a detriment by any means.
We have a big loan out to the Garnet, is it the Garnet mine?
We do, we have a big loan in the Garnet.
Loan portfolio. sure.
Yeah.
And loan portfolio.
Doug Space.
And you're certainly in the aggregates, that's, I mean, that's,
Right.
you're talking the precious
I
metal.
apologize, Representative Walsh. Yeah, that is technically mining. There's no doubt about that. Thank you, Carl. So we are doing that indeed. I guess open pit mining is, they are digging through the earth, but there is no acid leach mining associated with that, which is definitely associated with, pulling metals and ore out of the aggregate itself, when, whether it's precious metals or other, or industrial metals or otherwise. And before we committed to the aggregates fund, we actually did a site tour and spent a lot of time around the environmental remediation or prevention aspects of the actual investment strategy, and got really comfortable. It's basically like just blasting pre-existing rock. Sure. And brushing it up.
So the only thing I would add to that, and you can spot on, it's an area where we're certainly pretty sensitive to it. So we're not going to take on the headline risk that often exists there. I am sure, without having exact numbers, that, within our equity portfolio, passive asset management, we're going to have some of those, types of entities within the passive benchmark, but not an active, bets or anything there outside of that type of stuff.
We're gonna own, so you're saying we own stock in companies that
We
do
own,
mining?
we certainly own mining company stocks
Right.
within the, passive indices. Occasionally get, hit up by stuff like that, well, how come you own this? Well, because part of the index, we own the index, that's just how it is. But space is a little different in terms of we're making an active decision to manage something like that. We've stayed away from that, generally speaking.
Anything else? Anything else on the previous page, page 25? Okay, page 26, again, performance here, picture's worth 1,000 words, I guess. MLPs, oil has been driving performance over the last year. Any questions here? Okay, and then, so that brings us to the final page, page 27. Broken out the real assets portfolio for you. Again, no big surprises here. We continue to look at other strategies to further diversify our exposure. We had a positive cash flow quarter, no new commitments, potentially one coming before year end, but well, that's actually within the next couple of days. We'll decide there. The timber leverage profile is there. It's within constraints. Happy to answer any questions.
Anything else?
Okay. Yeah,
Thank you,
all.
Ethan.
Appreciate it. Thank you.
There we go.
Now we get to the good stuff.
Hey, John.
Putnam says if you underperform, you got to sit in front of the boards. Could I refer the board to slide 28, actually maybe slide 30, where you can see the core fixed income portfolio disappointing performance, minus 23 basis points to the index. I guess why it's disappointing is we were positioned short duration. Interest rates went up. That should have worked for us. And it did, except that when interest rates went up, they went up mostly in the 5, 7, 10-year part of the curve, less so in the front and less so in the very long part of the curve. We were dramatically underweight that long part of the curve, the 30-year to be specific. So if you think, I guess if I think about it visually, I think about it as that curve went up, kind of looked like a pig in a python. In that scenario, the python is the curve and our portfolio is the pig. So it was a surprise that the 30-year outperformed in the face of significant inflation. And so we made good money on duration. We lost it all on the curve. And then we the rest of the underperformance. So those two offset each other. We lost the rest of the performance on being underweight credit. But that all happened. That happened in the first quarter and was pretty well understood and built in. Going forward, we're still in the same position where we're dramatically underweight the 30-year. We're a little bit underweight credit, expecting risk to return and credit spreads to widen, and expecting the long end of the treasury curve. We expect those yields to increase, hopefully eventually reflecting positive real rates. If you think about what that effect can be when you're looking at risk and return, the duration of the 30-year treasury is right now about 22 years, maybe a little north of 22 years. So that means if interest rates on the 30-year go up 1%, then the value of that bond declines 22%. Doesn't really look like a very good risk return trade-off to own that 30-year to me. I guess that's all I have to say about the core portfolio. Any questions? Can I just hang out here?
Jason, are you with us?
I am here. No pigs, no pythons, but I'll work your way into the more exciting world of equities by bridging the gap, starting on page 32 with non-core fixed income. So at a high level, spreads are still tight relative to history. On the other hand, the quality of the high yield market is the highest it's ever been. If you look at the weight of BB credits in the benchmark, it's as high as it's ever been. BB is the highest credit rating category in the high yield universe. And while spreads are tight, default expectations are extremely low and have come down. I think the view now for 2022 is less than 1% for default rate. And, you know, we look for core fixed or for non-core fixed income high yield bonds to provide a yield advantage over core fixed income. But it's also important to note that the duration or the interest rate sensitivity of high yield bonds is much lower for high yield bonds than it is for core fixed income. That gap has widened over the last few years. You know, inflation has been a hot topic. The discussion around transitory, I guess Chairman Powell said today that we should retire the term transitory. And I think he penalizes people inside the Fed for using the term. They had to put a buck in the jar. But so I guess if we want to argue about what is and what isn't transitory, I guess the word transitory is transitory. So, but I think it may be unavoidable for us to retire that word, and John hasn't put out a jar for anybody to start paying up for using it, so I'll continue to use it. But so really, you know, with all this backdrop of some of the concerns that came about in the third quarter with inflation and supply chain disruptions, a background generally of economic growth is very supportive for high yield bonds and also for emerging market debt. Emerging market debt tends to be more sensitive to COVID scares and tends to be more punished heavily in a risk-off environment. But really at a high level, you look and we still live in a world where investors need income. And that is generally a positive for non-core fixed income. Page 33 shows the performance of the asset class. And a few comments here on page 34. For third quarter, our high yield managers generally kept pace with the returns of the benchmark. There was a low difference of returns among the different ratings categories, which is a departure from recent trends. We've seen over the last couple of years, dramatic outperformance by the lowest quality, highest credit risk, highest spread bonds, distressed bonds. So that was not a factor really in the third quarter. And so our managers have been more conservative in this respect, looking at those low quality, high credit risk as not attractive risk reward opportunities. And so that has been the primary driver of underperformance in the asset class over the last several years. For the quarter, our preferred manager and emerging market debt manager outperformed their respective benchmarks, and they have so year to date. I think since inception, we added them last year. But the absolute returns for those strategies, if you look at the benchmark returns for those strategies, lagged those of high yield. And the high yield benchmark, or the asset class benchmark, is the high yield benchmark. So even though that those managers added value, the allocation to those strategies hurt relative returns for the asset class. There were no changes to our manager lineup and no contributions or withdrawals in the asset class in the third quarter. Any questions about non-core fixed income before we move on to the exciting world of equities?
Anything? Okay, Jason.
All right.
You can keep going.
So moving here to page 35. U.S. stocks had a strong returns through August, but increased concerns over inflation we discussed and supply chain disruptions led to a late three-quarter sell-off. And with the sell-off, we saw a few things. We saw cyclicals, which had a tremendous run dating back to November of last year with the Pfizer vaccine news. Cyclicals cooled off. We saw a return to a more concentrated market where the largest stocks in the index, the large cap growth stocks, a few of them outperformed, and value stocks and small caps lagged. Valuation is still on the high side relative to history. I think, judging by the the analysis we used from JP Morgan, which I think John had some charts there earlier, it's a little bit outside of one standard deviation versus the 25-year history. And while markets are trying to digest the impact of inflation and supply chain disruptions and how the Fed might react, and now they're trying to digest what might happen with this new variant, we have seen strong returns in the fourth quarter and a continuation of a market being driven by the returns of a small number of stocks, those large cap growth stocks. Page 36 shows the performance over longer term periods. A few comments here on page 37. For the quarter, every active manager outperformed its benchmark, but the overweight to small caps, which was slight, small caps lagged large caps, that hurt relative performance. So what you ended up having was more of a benchmark-like returns for the asset class. Over the last year, though, the asset class had excellent performance relative to the asset class benchmark, with manager selection the driver of outperformance. And there are some of the a couple of the names, Jacobs, Levy, and DFA, that were the primary drivers of that. Page 38. At the end of the third quarter, the asset class was over half allocated to index funds. As you know, we made the decision to allocate all of the asset class to index funds, or what we call index-based investments, which would be exchange-traded funds or ETFs. Generally consider these passive investments. So a transition manager was selected. The transition began on November 15th. And currently the transition of all the assets from the active managers that were terminated to the passive investment managers, that is all complete. The trading, trading is 99.99% complete. There are 2 stocks that are relatively illiquid that the transition manager has to liquidate, but essentially the transition is complete at this point. Any questions about domestic equity?
No, for God's sakes, keep going.
I can do that. Page 39, international equities. They were down in the third quarter. They trailed U.S. stock returns. Really, the story of the third quarter was for international equities was emerging markets, which developed markets were down just slightly, but emerging markets really suffered from the sell-off in China. We talked about the regulatory scrutiny by the Chinese government, the stress at a large property developer that spooked investors. So Chinese stocks were down 18% in the quarter. That really weighed on emerging markets and too on international stocks. And the sell-off in China really hit the large Chinese tech companies the hardest. So in international equities, small caps and value stocks tended to outperform large cap and growth stocks. As we mentioned before too, emerging market equities like emerging market debt are especially prone to shifts in risk on, risk off markets. Year to date is the supply chain disruptions, inflation, COVID concerns, a little bit from a stronger dollar. Those have all weighed especially hard on EM stocks, which is compared to developed markets. Page 40 shows the performance. A few comments here. On page 41, the asset class performance for the lagged index for the third quarter and also for the trailing 12 months. Some of that was from small cap, slight overweight to small caps, although an underweight to EM stocks helped a little bit. But really active manager performance was mixed, but generally negative, and that was a drag on relative returns for the quarter and also for the trailing year. But the longer term performance is more positive. Asset classes outperform the benchmark over the 5 and 10-year periods. And on page 42, just a few notes on the structure of the portfolio. About half the asset class is allocated to index-based investments, passive investments. No real major style or factor bets. We do have a slight overweight to small caps and slight underweight to emerging markets, but that's about it. And no manager changes in the quarter or any contribution withdrawals in the asset class. Any questions about international equities or anything else?
Seeing none. Go on to Step.
Yep.
Thank you.
Jason.
Thank you.
Good afternoon, everyone. We'll make this quick like I usually do. The yield and STIP is still very low, about 10 basis points at the end of the quarter. We're starting to see a little bit of pickup in the long for STIP, about 1 year, what we can buy there. So maybe there's an end in this super low rate environment shortly. I will point out that Treasurer's Fund is still over 44% of STIP, but now that we've approved the policy statement to start investing in trust fund there, we'll start to see the balance of both STIP fall and the Treasurer's Fund dominance in the fund drop. Are there any questions about STIP? Thank you.
Thank you. State fund?
The state fund, yeah.
There you are.
I'm sorry?
I was looking for you up on the screen.
Oh, yeah. No, you're lucky to.
Yeah,
right
I
here.
know.
Better performance at state fund, a little better than 4% on the year. So that's driven largely by equities. The investment grade portfolio did outperform the index by about 44 basis points. Big difference between that portfolio and the core is that that is an intermediate portfolio, so it doesn't own, nor is there in the index, the 30-year treasuries. So no real effective duration on that portfolio. The outperformance came from owning over index weight of corporate credits and then having those spreads compress through the year.
Corporate credits on the fixed side.
Yes. Yep.
Say
Yep.
that
So-
again, Mark?
Overweight on corporate credits on the fixed portfolio.
Right, and so just to clarify, fixed being both in terms of fixed income and in terms of fixed rate. Either way, it was fixed. Yeah. We did sell about 45 million in equities during the year just to remain below the 15% cap. Any questions on state fund? Going on to trust fund, the pool outperformed the benchmark by 130 basis points on the year. Please do remember that we changed that index from just the Bloomberg Barclays Ag to an index that is proportionate Ag, real estate, and high yield. So we're still, because we did that mid-year, we're enjoying the benefit of that apparent but not real difference in performance. So one more quarter to go there, and then you'll have a good 1 year comparative number to the actual index. Real estate had a return of a little better than 7.6%. The internal portfolio returned negative 97 basis points, slightly under its index, just due to the fact that that one is slightly underweight corporates. Trust fund investment pool, as you know, is ramping up real estate significantly. We bought a little more than 225 million in real estate in that year. That with a few additional purchases after quarter end has got us to a little north of 21% in real estate. We expect to continue to go into the upper 20s % range there. Any questions on the trust fund?
What's the exposure to high yield in the trust fund?
It is, I don't, can you look in the, I didn't bring the index, but it's a little north of 7%, I believe. Actually, I think my pages.
And so only in the trust fund pool.
Right. So it owns investments that are managed by our high yield managers.
Hey, anything else? If not, I think we're done, right? Done?
That's all from me, unless you've.
Unless there are any
got other
questions. All right, well, we begin.
7.8%.
What is it?
7.8% high yield and investment.
Okay. So tomorrow we have TRS and Ampera, right? And then the loan program and.
Are we actually having actually?
No, just the, we're not gonna try to make you wake up to that, no, just Director Schwinden and Director Graham will come over. And actually, there was a presentation on your desk this morning, just a PowerPoint as opposed to the actuarial valuation from TRS.
Frightened me.
Yeah. You have the whole report, it's available if you want.
All right. Well, unless there's anything else, we're adjourned for the day and we'll see you at 9:30.
Yep.
All right.